lost all trust that there ever was. And the remarkable thing about the story right now is that there is no good outcome from it either. The bank's management was lying to investors, which is obviously bad, or if they were telling the truth, and outflows actually stopped, but then resumed shortly after, then it shows you that the management either doesn't know what's going on with the sentiment around their own bank, or they are unable to steer the bank in the right direction. So whatever the outcome from the story will be, whatever the regulator will conclude, it's bad for the bank either way.
Do you, and this is completely unfair, but with your experience, I think it is a bit of a fair question to take advantage of your years of doing this. Forget about the marketing, the branding, the cute phrases. Is it simple that wealth management assets will be sustained by the influence of Middle East big money saying, we own this bank, you've got to put your money into Credit Suisse?
Well, that can certainly help, I would say. But I mean, like wealth management for Credit Suisse is more than just the Middle East. If they have a foot in the door there with their owners, that's certainly going to help to create some momentum in that area. But you also need Asia, you need Europe, you need the United States. And as again, banking is a business of trust. And if you don't have that trust, you can do all you want with what your owners are saying. But when the individual people, investors, and the people who bank with you are not willing to do this, I have very little hope for Credit Suisse putting out a turnaround story that will be rather fast.
Jan Patrick, let's just talk a little bit longer about the regulatory scrutiny that this bank is attracting this morning and why. It wasn't just the comments, it was the timing. So the comments he made to Francine Lacroix that the outflows had basically stopped in December. We understand those remarks were made right before the closing of a $4.4 billion capital raise. Now, Jan Patrick, are we aware of the disclosures they made to the people who bought into that capital raise? Do we know if he told them exactly the same thing and that was what came directly from the bank?
So we don't know that, but the timing, as you point out, is horrible because it comes with a little bit, not just a little bit, with a really like bad taste in your mouth that those comments come in the middle of a capital raise, which went okay, but then of course people now have the feeling that they maybe have been lied to or misled or whatever, or even again, even if they were not lying or misleading, if they were just like telling people what they were seeing, again it shows you that you have a management in place that is unable to make a solid prediction and to tell people this is where we are and this is where it's going to be. And if you have that, I mean, how can you trust that bank either with your money in wealth management or with your money in the stock? I don't see it, and it's going on for quite a while now. And the cheaper the stock is going to be, the more trouble they will have to rebuild this trust. And we have seen this with European banks in the past. It can take years and years and years, and maybe another change in management. Who knows before you actually reach a bottom there?
Do they have years, Jan? If they are losing trust, if they are losing client money, if they are losing market share in other businesses?
It can take the bleeding can go on for quite a while, I would say. Like, I mean, at some point, I mean, Credit Suisse is so cheap now on paper. I mean, bank to book to price ratio is at 0.2 something. I mean, at some point there maybe is the idea of a takeover idea there. But I mean, like, why would you buy the bank right now? I mean, if the clients are coming to you anyway, so you don't need to buy them. So I don't see that happening. So it could well be, in my view, that the bank is just like not ceasing to exist, but becoming smaller and smaller and smaller over the years, and the bleeding will go on and go on and go on. Maybe not at the same pace as we're seeing it right now, but I think there's a realistic chance that Credit Suisse will never get out of this in the next 5 to 10 years.
Is this okay for the Swiss authorities? I mean, on one hand, you have regulatory scrutiny over misleading investors. On the other hand, is there a sense that they want to back a bank that is part of the national ethos?
Well, I don't think they don't want to do this. Of course, you want to make sure that there's a stable banking market in Europe, and you don't want to go Credit Suisse to cause any disruptions in the wider banking system. But I don't think that's going to happen. I think there's no issue of liquidity on the horizon. It's just like a constant decline of the bank going down, and this trust is like breaking away further and further and further, and the stock price is going down further and further. No drama, no crisis in banking here, and hence there is no real reason for the regulators to support the bank. They just can sit aside and watch, as can the management of Credit Suisse, and just watch the bleeding, and there's very little they can do unless they really have like come up with some strong message to rebuild this. But from the current management and the one before, We have not seen that, and there's no feeling of confidence from them into the lender.
There's a ton of bleeding this morning again and over the last year, that's for sure. Jan-Patrick Barnett, thank you, sir, of Bloomberg. Breaking down the latest on Credit Suisse, the stock is down by 6%, another all-time low for the stock. We trade with a two-handle, have been for quite a while now, 260 in and around. And TK, it's up to them to come out with the relevant disclosures, I guess communicate with the regulator, and we'll talk about the outcome of this regulatory scrutiny. I'm sure they have some data, and we'll see if it backs up the chairman's comments.
I don't have the balance sheet in front of me, and I don't have the PowerPoint. And again, I said this earlier. I give them great credit for showing the balance sheet, the traditional banking balance sheet away from what Jan-Patrick was talking about, wealth management. But with equity down, I got a weighted average cost of capital, equity weight 4.5%. Debt, 95.5. Can we round that up to 96%? This is, I mean, the phrase, and I got to be careful here. In America, we'd say, is this a going concern? And I don't know if the Swiss are saying that, but what do you do at 2 francs 30? What do you do at 1 franc 98? That's sort of what I'm thinking.
I'll be slightly more diplomatic about it. I think it's described as the problem child of European banking in the same way, Lisa, that Deutsche Bank was many years ago.
The difference here is that it's not a liquidity risk. It isn't a systemic risk. So there's probably less incentive for some of the authorities to come in and step in and back the bank. And that's really the slow bleed that you're seeing in the shares. They are well capitalized. They're not about to necessarily be a systemic problem. And that's why perhaps they're not going to get bailed out in the same kind of way.
Do you further dilute people down to 2.20? I mean, it's...
Well, if they did another capital raise now, Tom, if they did, and we're just exploring this, if they did, and it turns out that the chairman's comments were incorrect,
I don't know.
How's that capital raise going to go next time around?
My arch question that I would ask regulatory experts is their behavior and the relationship to regulators. Would it be the same in London with FSA, or would it be the same in the United States with the Fed? And my answer is it wouldn't be.
Bottom line, Jan-Patrick, I think, put it correctly. It's eroding trust, ultimately. And the perception this morning is this erodes more trust, and it's up to Credit Suisse, and I'm sure they'll come out with their own comments on the matter in the not-too-distant future. Equity futures right now down 6 or 0.7% on the S&P 500. Fed minutes coming up tomorrow. Bit of economic data out of the United States in the 9 o'clock hour. So I think about 9:45 Eastern time. Mike McKee's going to break down some PMIs. The PMIs out of Europe, better than expected. Yields higher across the board around the world, including in the Treasury market, up 6 basis points on a 10-year, 387.47. On this bond market, Nicola Mai of PIMCO coming up.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Market was priced for a soft landing, was very enthusiastic about a soft landing. And we had called this year a roadmap to recovery.
The likelihood of a soft landing, a garden variety recession, even maybe a small chance of a hard landing, that's all there.
Central banks now have to make a judgment on how persistent those upside surprises are going to be.
We're in the camp of a couple more rate hikes for the Fed, but not giving up on the disinflation story.
If the Fed really wants 2% inflation, they have massive amounts of work in front of them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Welcome back, everyone. After a long weekend, markets reopened. TK, welcome back. To you as well, Bramo.
Thank you.
Futures negative 6 or 7 tenths of 1%. Just starting, you know, in a warm, nice fashion. Good morning to you all at home. For our audience worldwide, this is like smooth radio.
I was about to say, what is this?
Jazz.
Smooth jazz. It's going to last. How long is it going to last?
The 9 p.m. Eastern Time edition, 10 p.m. late night kind of stuff. Smooth tunes, you know, croaky voice. A few scotches with Tom.
Did you used to sit around and listen to Kenny G?
No, I didn't.
You know.
Did you?
No, I knew the Spire Gyro.
He plays the saxophone, actually, right?
But it's a little treble or tenor sax.
Okay, nice.
I knew the Spire Gyro people when Fusion.
We should get some music on the program and start with some sax.
I don't think it's going to be Kenny G. That's just my hunch.
The markets are open.
Good morning, Buffalo.
So let's get to that. Futures negative 7 tenths of 1% on the S&P. Yields are higher in Europe. This works. You want to keep the sound going? Music? Nice. Yields are higher off the back of better data in America. Lisa's going to go through the data a little bit later. We need to talk about earnings as well, Tom. We had Home Depot out a little bit earlier. Lisa, what have we got on the Walmart side of things?
So if you take a look, the adjusted EPS is expected to be about $1.25 versus that's better than expected to $1.30. You're also looking at an adjusted year earnings per share of $5.90 to $6.05. The expectation for the fourth quarter was $1.52. It came in $1.71, so beating across the board. I'm curious, though, to dig through the numbers to really understand whether you're seeing the same kind of margin pressures that you saw over at Home Depot. Are they raising wages and not able to pass that along to consumers?
Stock's up about 3% year to date. Coming into this, Tom, we're up 6 tenths of 1% to 1% higher off the back of this in a pre-market.
It's different than Home Depot. All the big, but Joe Feldman is great on this. It tells the advisory group, saying that every big box is different, target's different. And what I see here, John, is a nominal GDP set of headlines. You've got an estimate of U.S. comparable store sales. Ex-gasoline, to me, that's important. Nice beat, up 5%, is up 9% to round it up. And you really wonder what the forward vision is. Can they give us a nominal GDP forward vision or not, as we heard from Home Depot?
Stock now down about 2.5%. What have you got, Lisa?
I'm looking through this, and there is this potential opioid legal charge of $3.3 billion. They're also talking just in general about the situation. They're closing some of the inventories. They're lowering their inventory buys. Basically, fourth quarter inventory total went down 2.6%. I don't know that I'm finding some dramatic weakness here. It's just that clearly they're facing the same pressures globally you're facing, but I'll have to dig through the numbers to understand what people are seeing.
Well, stock's up by 1.7%. No real drama off the back of those numbers. Home Depot a bit softer through this morning as well. Margin pressure off the back of a bigger spend on labour costs. We'll pick up on that a little bit later. For the broader market, we look a little something like this on the S&P. We're down 0.75% on the S&P 500. The moves in the bond market, TK, let's be clear about that. Yields up again by 6 basis points. Your 10-year just short of 390.
Yeah, I'm going to look out 30-year 3.92 as well. And the inversion, I mean, it's, excuse me, it's dynamic right now. But I would go, as you say, John, to level of the core yields of a 4.66 and then out to a 10-year 3.88%. The 3.88 is different than 4.00, but we're moving there with rapidity.
The focus has got to be on Europe as well, waking up this morning. Lisa, bottom line, the data's better in Europe, and not just the Eurozone, but also the UK as well.
Okay, I'm going to drive you crazy, but bad news, good news is bad news in this particular situation. And the reason why is because you can imagine the ECB going further, which is all the more interesting that you're seeing dollar strength, because perhaps people think that it's all the more so in the U.S. Today, we're at the heart of retail earnings kicks off. We already talked about Home Depot, those shares lower. After it was clear that you're seeing margin pressures, Walmart just came out, and those shares are also lower. We're parsing through the numbers to try to understand why the year-over-year comparative sales without gas rose much more than expected. So how much, as we dig through the numbers, will this also be margin pressures? CPI year over year, you saw that come in hotter than expected. How much more are some of the consumers willing to absorb in terms of the costs that these companies are incurring? Then, of course, today we also have President Biden, who's going to be meeting with the Polish president. He's going to be speaking at 11:30 a.m. What does he say in terms of the scope of aid to Ukraine? I'm also curious whether he really talks about China and China's role. We heard that from Tony Blinken. I really, again, that was what stood out to me this weekend, this idea that the U.S. suspects China of thinking seriously about providing aid to Russia. And then following on with Europe, we did see better than expected services PMIs come out of Europe. What do we get from the U.S.? The S&P Global Manufacturing Services PMI for February coming out after we saw the biggest rise in Euro area business activity in 9 months. Do we see a similar kind of rebound, John?
Elisa, thank you. To focus on Europe in a big way in the last 24 hours. An unscheduled visit by the President of the United States to Kyiv, at the epicenter of a war-breaking gale in Europe, Tom. Just looking at live pictures coming through from the presidential palace, awaiting the arrival, Tom, of the U.S. President, Joseph Biden. That's set to take place any moment now.
This is hugely symbolic, and it is the might of Poland. And I might also point out, John, and this goes back 30, 40 years, and with President Carter so ill, we go back to that era. It is not a small matter here that the Ukrainian and the Polish population in America, to use a scientific word, is truly ginormous. I mean, there is a domestic resonance here for any Democratic and Republican Party member as there is the international ramifications.
For anyone with one eye on the clock for this morning, so this is already about 15, 16 minutes later than scheduled, this arrival, Tom. We did have a scheduled bilateral meeting at 7:30 Eastern time, so about 24 minutes from now. That's probably going to get pushed back just a little bit. So we'll look out for headlines from that, and from headlines a little bit later on, as Lisa pointed out, 11:30 Eastern time, we get remarks from the president, at least we're scheduled to, on the one-year anniversary, Tom, of Vladimir Putin's invasion of Ukraine.
This is, I know we've got to get to Nicole here, but this is so important. Robert Service, the esteemed Oxford historian, expert on Lenin, just put out a blistering tweet where he said, look, the Putin conversation sounded like Stalin in the 1930s. You think that's a big deal for us? Imagine what that's like for the Polish people.
But Tom, frame the contrast right now, and we can have that conversation with Nicola Mai. The contrast right now between the conversation Lisa just had with myself about the data in Europe, the economy's doing better, and what you're hearing from officials in Europe on what's taking place in Ukraine, which is just dreadful news. Nicola Mai joins us now from PIMCO. Nicola, the economy's better. The data's improving. Yields are pushing higher. And I think on both sides of the Atlantic, we're trying to work out how far these central banks are going to go. The ECB, the Federal Reserve. Nicola, based on where you were maybe 3 months ago, where are you now?
Yeah, I mean, I would say in Europe, the economic resilience has been surprising. Obviously, the huge fall in gas prices is a big factor. And, you know, China reopening is boosting sentiment. And there's a lot of pent-up orders that were built during the pandemic, which are being filled now. There's excess savings. Bottom line, I think we've skirted recession this winter. And I think recession was one of the key drivers of the disinflation that we were going to see ahead. And I think by now, with the economic resilience, we have to expect the disinflation to be slower than before. And as a result, the ECB going to 375 as a peak, which is where the market is priced now, is reasonable. But I would say there's a little bit of upside risk to that. The hawks and the doves at the ECB have taken very differing views, but I would say the hawks at the moment, given the data, have the upper hand.
When I read the analyst notes over the weekend, people were talking about the potential vulnerability of U.S. credit as central banks around the world raise rates. But they talked about Europe performing better, even though credit spreads have contracted so much. Do you push back on this optimism about Europe in light of just how far the ECB is going to have to go?
Well, I would say that, I think we should expect below potential growth, maybe a stagnant economy this year, partly because the monetary tightening will have an effect. It's possible that we'll go into a recession, but I would say the recession will most likely be mild because household and corporate balance sheets are pretty healthy, and there's this cushion from excess savings and pent-up orders that I was saying. So I think you want to, I think credit is okay, but definitely you want to stay in the investment grade space. You want to stay in the safer areas of the market. I think you want to be careful with high yield. You want to be careful with equities, partly because in the safer parts of the markets, you get juice that you didn't have until not long ago. So take risk, yes, but stay in the safe space because the monetary tightening has more impact to have.
I want to build on that, Nicola. I think you're making really important comments. I want to understand if there's credit risk in the sovereign and the perceived safety of sovereign debt in Europe, maybe that's where the risk lies. Nicola, do you see an inflection point at some point? We've had an orderly pricing in sovereign debt markets of higher terminal rates, the prospect of stickier inflation as well. Is there an inflection point where things get to a certain level in Europe where we start to think about credit risk again?
Well, at these levels of yields, that sustainability in certain countries, including Italy, starts to be challenged. I would say, though, that compared to a few years ago, a few things have changed in Europe. First of all, significant fiscal integration via the Recovery Fund. Secondly, the ECB has shown that it is a lender of last resort for sovereigns when push comes to shove. And also, I think Euroscepticism more broadly has gone down as a political theme across the region. So as much as that sustainability becomes more of an issue, I think these factors are going to anchor the sovereign debt markets in a better way. So we could have a bit of a widening of sovereign spreads, but I wouldn't expect a crisis environment going forward.
Nicola Mai of PIMCO. Nicola, thank you. Always appreciate your thoughts, sir. Thank you very much on this fixed income market. Tom, I think that's the major risk, and I stress major risk, the ultimate tail risk, so to speak. If you're pushed into a situation of fiscal dominance, where the central bank has to come in and contain bond yields, even if inflation's going to be stickier, that's going to be the big call for real currency implosion in certain places. I don't think we're going there. I think we saw maybe a test case of that in the UK in September when cable dropped to 103.50 and the central bank had to step in and contain gilt yields because of what was happening with pension funds. That's going to be the big risk on the radar for a lot of people through the year ahead.
The big risk is to overlay all the central banks as one. They're dramatically different. I think the euro, we overestimate that the ECB is like the Fed. It's not.
Totally agree. Yeah. Totally agree. I've always said the major difference is that Chairman Powell doesn't have to look at what's happening with BTPs in the Italian bond market. Lucky him. Futures right now down 0.8%. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Vladimir Putin had a warning for the U.S. and its allies in today's State of the Nation address. The Russian president threatened a backlash if they supply Ukraine with long-range missiles. Putin vowed to press on with his faltering invasion. He also said Russia will suspend its participation in the new START nuclear weapons treaty with the U.S. President Biden is seeking dividends from his surprise trip to Ukraine. The president's hoping to rally new support for the Ukrainian efforts against Russia as he meets with Eastern European leaders in Poland. Shortly after President Biden's visit to Ukraine, the U.S. announced $460 million in new military aid. China is urging the world to stop saying that Taiwan is next after Ukraine. Foreign Minister Qin Gang says that certain countries should stop fueling the fire by blaming China and saying, quote, Ukraine today, Taiwan tomorrow. Beijing has been trying to distance itself from Russia and portray itself as a neutral force for peace. In Turkey, a pair of earthquakes rocked a southeastern province 2 weeks after major quakes in the same area killed more than 40,000 people. Monday's quakes killed at least 3 people and injured more than 200 others. Turkey's government has announced that it will start building about 200,000 homes in the hardest hit areas. And Home Depot is forecasting a decline in full-year earnings. The outlook signals a slowdown in do-it-yourself spending at the home improvement retailer. Meanwhile, Home Depot is spending $1 billion to increase hourly wages in a tight labor market. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
Could face bigger challenges next.
Was going to keep Rain World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
The President of the United States has just arrived at the presidential palace, Tom, in Poland. That motorcade just pulling up just moments ago.
The history of this, John, is extraordinary in this moving from Ukraine over to Poland across that fractious border with Mr. Putin speaking in Moscow. And all I can think of is it's not that it's back to my youth, but the answer is we didn't imagine this 2 years ago, certainly before Crimea in 2013. I would focus as the president meets the dignitaries. For those of you on Bloomberg Radio, it is a very traditional meeting. President Biden, no doubt, knowing many of these Polish authorities. And John, it's 700 miles north from Warsaw to Helsinki. And that's what this is really about.
Well, Tom, you said that this is a situation we couldn't imagine a couple of years ago.
Yeah.
I think for a lot of people, even 12 months ago when this war started, there was a real hope that we could move on quickly. And here we are, TK, 12 months later, still talking about this. And the kind of things that were red lines aren't red lines anymore. You remember only several months ago when it came to sending battle tanks to Ukraine, that was perceived by the administration and others, not only as unthinkable, but also an escalatory step. And here we are. And now we're not talking about tanks anymore, Tom. There are people having real discussions about sending jets.
For the international audience, and I think every nation's different, but there is a codified reality, and this is wrapped around the presidential birthdays of Lincoln and Washington, that a war that's appropriate in America is 4 years. We were weaned on that, John, and World War II was a little bit outside that for America. Let's call it edging on to 5 years. But the more recent wars have dragged on. There's a huge sensitivity now in America that a 1-year war becomes a normal 4-year war that comes outside that, as we've seen in recent efforts over the last decades.
Well, Tom, that comes down to the decisions of Vladimir Putin, the Russian leader.
Which was reaffirmed today.
And also a real worry within the administration that has come to light in the last couple of days, that they're concerned that the Chinese Communist Party, may well begin to contribute to that Russian war effort.
Yeah, to our people watching on TV and listening on radio, we have a wall of TVs in our studio here. We're really valued to have that. And I pretty much see Mr. Putin selling to the domestic media in Russia every single morning in his afternoon, John. And Putin's out there every day reaffirming his message, which to Poland has a different tone than to Washington.
The President of the United States, Tom, alongside his Polish counterpart, that bilateral meeting about to begin. We may well hear a couple of headlines from the President a little bit later this morning, Tom. 11:30 Eastern Time is when he's scheduled to make remarks about the one-year anniversary of Vladimir Putin's invasion of the country.
This guy's different, with Anne-Marie Horton there. We're going to go to her, I believe, right now. Anne-Marie Horton, this president of Poland standing with the president of the United States, he has a true affinity to America.
Yes, he certainly does. Ahead of President Biden's trip, he was talking about the fact that he wanted the U.S. president here and welcomed him here because he says this is a show of force and a sign not just to the support of Ukraine, the country they obviously share a critical border with, but to the Polish people. This is a country that has welcomed so many of these refugees that had fled Ukraine in the wake of Putin's invasion. I mean, you look at the pre-war levels of the population of Ukraine, over 40 million people, about a third of them have fled. Poland has really been ground zero for that support, that refugee support, and it's the security concerns. And Poland wants to make sure the U.S. is ironclad with that security support. And as I mentioned in the last hour, not just because of the obvious security issues, but also because Poland wants to make sure it is a safe place for the economy and the business to thrive as they are dealing with this neighboring war.
I look, Anne-Marie, at the leadership of Poland. How are they distinctive from other Eastern European countries? What is the Polish distinction of the Budapest Nine?
Well, there's one clear distinction when you look at, say, Poland versus maybe Hungary, right? And that is that Poland has been very steadfast in the fact that they've been pushing the European Union to do more when it comes to sanctions. I mean, if you just look at the energy landscape, that has changed dramatically over the course of the past 12 months. This is something that Biden in March, when I was at his speech last year, talked about. He said one thing was crystal clear, and he wanted to make clear to Europe when he gave that speech. You have to end your dependence on Russian fossil fuels. Poland has ended a lot of it, but still 10% of their makeup of crude comes from Russia. And this is because of the Druzhba pipeline. Russian crude is still flowing into Europe. And regardless of some other Eastern European countries who say that that might be needed, Poland is willing to have these sanctions and end it for good. Their issue right now is with contracts. So they are out front really speaking heavily about the fact that they want to end all ties with Russia, while you see others potentially want to keep some business ties intact.
I keep wondering, what would Germany say? What would Germany do? Because this is really saying to Germany, increase some of the sanctions, increase some of the potential restraint on the Russian economy. And I was thinking over the weekend, what would Germany do if China took a more direct stance in helping Russia, as the U.S. administration is concerned about? How much pressure is there building on Germany to really take a harder and more public stance to support its allies, both in the U.S. as well as in Poland?
Well, I think the United States, and they've been talking to all their allies, whether it's the Munich Security Conference or behind the scenes, and obviously today and tomorrow in Poland, about what China is doing. And we just heard about an hour ago from Jens Stoltenberg, Secretary General of NATO, really repeating what Secretary of State Antony Blinken said over the weekend, which is that they see this non-lethal material support coming from Beijing to Russia. But what he told CBS News is that they are seeing concerns, potentially information, that Beijing is preparing to send lethal weapons to Russia. Now, this will be a difficult moment, not just for Germany, but for the world. While, of course, Russia and China are very close, I mean, this has been setting the stage, this friendship, for years. But obviously, last year, they decided to announce this no-limits friendship. But even years ago, 2018, Xi Jinping said, President Putin is one of my intimate, most best friends. At the same time, it's not lost on Beijing the trade that Beijing has with Moscow dwarfs what they have with, say, the United States or Germany. But this is going to be a very difficult line for Beijing to walk, especially now that they are proposing this peace plan out in the front and the surface, but behind the scenes, they are still making sure they're keeping that communication open with Putin. And Xi Jinping has spoken to Putin 4 times since this war broken out. He has yet once called President Zelensky.
That said, Germany also depends greatly on flows with China, on trade with China. So on that side, how much cohesion is there among the Western allies to take a pretty hard line with this?
Well, I think what you're seeing right now is the hard lines are coming behind the scenes, right? I mean, this was also off of the acrimony between Beijing and Washington of the alleged Chinese spy balloon. So there's big tensions between Washington and Beijing. We also, though, had in the past few months, Olaf Scholz head to China. This is a difficult moment for these Western countries that are trying to potentially diversify out of China. All of their economic prospects, so much of it is reliant on China. So I think behind the scenes, what you're going to be seeing is these meetings where they take a very tough line on China and try to make sure that Beijing does not step over that line that Secretary of State Antony Blinken was talking about over the weekend of sending that lethal support to Russia, because that would be a line that would be very difficult for the allies to ignore.
Do we have any idea on what congressional support for funding this war in Ukraine would look like, Anne-Marie, if there was a real risk of a proxy war with China?
Yeah, it's a great question, Jonathan. But as we've talked about for months, you'd be hard-pressed in Washington, D.C. to find anyone who does not want to take a hard stance on China. So I think what you can see there is that this would tip Congress into wanting to fund that support. I mean, what we've seen time and time again from Republicans and Democrats is they want more to be done in combating China and also sending more support and aid to Taiwan as well.
Anne-Marie, AMH in Poland. Anne-Marie, thank you for the coverage there. Tom, I think it's a very different question when we're not talking about the economy and we're talking about military action.
Oh, yeah, huge. There's no question about it. I'm looking at the feed here from Putin's speech, which I think has had less coverage today because of the pomp and circumstance of Warsaw. And it's interesting to see experts. I mentioned Robert's service earlier and other historians just saying the word that was used, one was alternate reality, is maybe what we're dealing with there. I think there should be more attention to what Mr. Putin said in his lengthy speech.
Well said. Equity futures right now down 8 or 0.9% on the S&P 500. Bond yields a little bit higher. Economic data in Europe better. US data still to come a little bit later this morning.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Two-day losing streak on the S&P 500, 2 weeks of losses as well. A slight loss to mark last week. We're adding to those losses this morning. Good morning to you now. We're down by 0.8% on the S&P. On the Nasdaq, we're down by more than 1 full percentage point. Walmart, Home Depot not helping out that cause. Lisa will get to that in just a moment. In the bond market, we look like this. 2s, 10s, 30s, yields up 5 basis points at the front end. Having another look at 470 on a 2-year at 467. Having a look at 390 on a 10-year, up 7 basis points at 389, I guess we can call that. The focus on Europe so far, the data better. And it's not just the Eurozone, it's the UK as well. There is a real conversation about the UK avoiding recession. Europe avoiding recession. The ECB's got to do more. The Bank of England might have to do more. Euro dollar negative 1/3%. Lisa right here at 106.52.
And it is interesting, and you pointed this out, that there was better than expected services PMI data out of the euro region, and yet the euro is weakening versus the dollar. So either people are expecting it to be even better in the U.S., or the tightening cycle in the U.S. is going to be that much faster than people expected, and that delta between the euro tightening that much greater. So let's talk about the earnings that we've gotten. What they point to is margin pressure. What they point to is not being able to necessarily game out how to maneuver in what is a very uncertain macroeconomic environment. Home Depot shares lower by more than 4% after forecasting a decline in full-year earnings per share. They also are spending $1 billion on increasing hourly wages. Again, wages up, not being able to pass it all along to the consumer. Walmart, we've been parsing through. They actually had a disappointing view forward in terms of what their profit expectations are for 2024 and for parts of this year. But just to put this into perspective, Walmart saw the largest sales volume month in its history in December. This isn't a result of people not necessarily having demand. I want to read you just what the CFO is basically saying. There's a lot of unpredictability around what's happening, what will be the effect of Fed tightening on the consumer balance sheet, what is the effect of this declining savings rate. We feel good about how the core business is operating, John, but we're being cautious with the macroeconomic outlook. That's really the issue.
Well, I think they're right to be cautious. It's been very difficult as a retailer to understand these post-pandemic realities. They raced to get inventory. They got all the inventory at the wrong time. Then they had to get rid of the inventory, and we were talking about goods disinflation. That's happening at the same time the labour market's still tight. I mean, the margin story for a company like, say, Home Depot, that's the story this morning, isn't it?
It's all margin story. And how much do you get this really feeding into the Mike Wilson view of the world, which is basically you could get an economy that doesn't roll over while you also get margin pressure that causes a pretty significant issue for stocks. Meta, I wanted to talk about Facebook because they basically took a page from Twitter, and they're now going to charge for verification of certain users. And Elon Musk came out, of course, and basically said this is inevitable. But it just speaks to this new, more efficient, leaner, meaner machine that Meta, the Back to the Future.
Do you need a government ID to do that? I understand you might do.
I don't know all the details of it.
Are you willing to hand over those details to to Zuck & Co. over at Meta?
Well, it's a good question, right? How much are people willing to give? Because in essence, there's a whole theory that we're already giving our data, and that's our payment to them for the service that they provide us. So now to pay on top of it, what more do you have to give over?
I get the verification importance. I think we're all on board with that. It's about how you go about it and whether you trust the end platform, Tom, with that kind of information. Do you?
The ambiguity now is off the chart. What I'm hearing consistently, John, through every theme, including Lisa's good conversation, is we don't know. I mean, that's just simply where we are, waiting for the John Farrell year entry March 31 outlook for the rest of the 9 months. Here, you're going to talk up Mr. Wilson here?
Yeah, it's been a tough couple of months for anyone who wasn't long equities and long tech leadership, to be specific. Mike Wilson at Morgan Stanley pushing back big time. He says the S&P 500 could slide 26% the first half of this year. And he said this: the bear market rally that began in October from reasonable prices and low expectations has morphed into a speculative frenzy based on a Fed pause pivot that isn't coming. If you haven't managed to read the note that came out on Sunday, please do. It is a fantastic read, whatever your view on this market is. Tom, it's about climbing Everest and going into thin air, high altitude, and running out of oxygen, and making poor decisions at high altitude. Lisa, it's a great. It was a fantastic read. I really enjoyed it.
I love the drama. You know, the death rally or the death place or whatever he called this.
You're in the death zone.
The death zone in terms of the evaluations, with the equity rally becoming now the most expensive.
Some brutal stories about getting into the death zone, by the way, when you're mountain climbing. It is.
Oh, I thought you were talking Red Sox baseball.
No. We're talking about climbing and equity markets, apparently.
Don't they have oxygen? And if they run out of oxygen, they're
if you stop moving, it's like kind of over.
Game over?
Yeah, it's kind of over. I've heard some horrible stories about it.
Are you thinking of doing it?
No. I don't think I'm brave enough to go and do anything like that. But have you seen the pictures from Everest now that people are just in these long lines and they're just sort of, it's very strange.
The commercialization
of climbing Everest.
Yeah. Well, yeah. Tom, you want a road trip?
Tom's going to do Kilimanjaro.
We got a 6th floor walk up, so yeah, actually friends have done that. And it's harder, I think, than you think.
So I hear.
Kilimanjaro. Yeah. It's not like a, rich kids suburban walls.
Well, I think that's what certain rich kids think it is.
Yeah.
Yeah.
Yeah. Something like that.
That's what it is.
We're going to get the wheels back on the track here right now, and we do it with someone with some real experience. I've really been looking forward to that. Linda Dissel is with Federated Hermes and senior equity strategist, but far more. When they sit around the table at Federated, including with the great Stephen Auth, they have a little bit of experience. I want to look, Linda, at the Auth-Dissel experience of over the decades, the simple idea that if rates go up, we're all going to die. How do I stay in the stock market if nominal and real rates go up?
Well, yeah, if rates go up, then, depending upon where you are in the bond market, you could lose money on bonds. We think that rates really have peaked out here, so we don't think that you need to worry about that so much. What you need to worry about is the debt that's going up. And we have had a lot of experience at Federated Hermes. Steve Auth and I know for sure, amongst others, we go back and we've been around since the 70s. And I keep likening this time period to the 1970s, where there is stubborn inflation, where you have maybe not a wage price spiral, but a wage price problem that's going to last longer than many people expect. So how does one advance through this? They should be defensive.
I mean, your work at Carnegie Mellon, I mean, it's real simple here. You look at the x-axis, whether it's arithmetic or log. If it's going to be longer, how do corporations adjust, as we see with Walmart and Home Depot today? How do they adjust to the Linda Dissel world?
Well, it's interesting because profit margins are getting hit, but sales continue to go up, actually, and earnings are surprising to the upside. That's kind of what you see normally in an economic cycle. As the cycle gets stronger and people have more money to spend and they demand more of a pay, profit margins get hurt, but the bottom line actually goes up. So you can still make money in the stock market, but you're not at the front end of the economic cycle, you're on the back end, and that's when the Fed continues to raise rates. So we will agree that Fed is going to continue to raise rates. That's not the issue. The issue is how long will they stay up? How long will bond yields be up? And last week's CBO information came out from the Congressional Budget Office. We're going to have at least $22 trillion more in debt in the next 10 years than they thought just last May. So if you have a 3 to 5 year perspective, then you have to be sober in amongst all this FOMO activity that we're seeing.
So what's the distinction between the Lyndall-Dissel caution versus the Mike Wilson death zone?
I think the death zone is really, it's a tough one to be calling. For this year in particular, the consumer is extremely strong. Companies' balance sheets are extremely strong, and all we're doing here and around the world is bouncing up and down around a zero level in GDP. The longer term is more, I think, of a malaise type question. I think we here in the US are going to be saved, our day is going to be saved by the massive millennial and Gen Zs that are coming behind us baby boomers, and they will be extremely productive. Our country's one of the best in the world for the long-term future, but we need to get our act under control here as far as the spending that's going on, or there will be a forced austerity by way of a weakening US dollar.
So how do you express caution but not Armageddon?
Well, you can express
Lyndall-Dissel, that's federated.
Linda froze.
Just like
Linda froze
That's how you
over
do
the
it.
gloom of
That's how you do
Bremo.
it. Just to be clear, that's how you do it. You just say nothing. It felt like Bremo was asking for tips then. It's like, how do I express caution without coming across as conveying Armageddon?
Bremo goes all Armageddon there. Boom. That's it. That's in the control room. Farrell, you don't know, Lisa, but Farrell used to do that to me.
You would just freeze?
He'd hit the button so my mic would click off.
Just stop.
Seriously?
Well, we used to have a button in radio, yeah.
Oh, I remember the button.
Sure.
Yeah, well, it's sort of like kids when they were doing remote schooling and all of a sudden they pretend to freeze and there'd be a cat moving behind them.
Linda brings up a good point, which is not Armageddon, and it's not maybe Bremo gloom, but it's malaise. And is that the fear, John, that we just sort of malaise through Q2, through Q3?
You think I'm going to make a call on this year?
That we go edge
based
of
Bremo? Based on the first half of Q1 that we've just had?
Well, I'm just saying.
He's going to do it March 31st.
Lisa, don't you think malaise captures a middle ground between the surveillance death zone, the surveillance death zone, and the optimists that are out there?
Just to put some clarity on this. I'm not saying I'm calling for Armageddon or that I think that that's the case. What I'm looking at is a Mike Wilson view of the world, which sees a 26% decline to 3,000 on the S&P versus, what you see over at JP Morgan or even Bank of America. Michael Hartnett sees declines of 7%. That's a big distinction. So what is that distinction? Is it a leadership question? Is it the depth of some of the sort of earnings compression, the margin compression that people are expecting to see? That's really what I'm wondering. Linda Dissel was talking about the potential for people to keep spending in this robust economy. Well, they're spending, but they want deals. They're not necessarily looking. We saw that with Dana Telsey last week, Tom. She was coming out and she was saying, look, people are looking for deals. They're buying on sale. That's not going to be great for these margins.
I'm sorry, John, so much of this, and we're going to get this tomorrow. Edward Hyman pushes against this. I don't think there's never been an Ed Hyman death zone. Let's begin with that. He's a wonderful optimist on the American economic experiment. But I want to make clear, and we heard it from Ben Laidler, frankly, and John Stolfus has done one, not two. John's done 2 notes this morning calling this a baby bull market moments ago. There's a whole group there looking at this as the American innovation zone.
Short answer, all of the above, Felisa, all of the above. Coming into this year, we were hoping the disinflationary process had started. Chairman Powell said it had. It was about a question of whether that spreaded to services and how quickly that took place. Now we're having a conversation about whether it picks up again. And that's a real change from where we were just 2-3 months ago. And at the epicenter of that change was just the January data. So now you're face down February and you're asking a question, okay, does February confirm January? Basically, and Mike Gapin of Bank of America was saying that if we get another big payrolls report, that's going to communicate to a lot of people that there was more signal than noise in the January economic data, and then we're going to have a completely different conversation again about terminal rates.
It's going to be a huge concern for the Fed. It would freak them out, I would argue.
I remember Bear Grylls. Do you remember Bear Grylls? He did a great after-dinner speech at Aberdeen at the Savoy Hotel more than a decade ago, when Aberdeen had the vows. Long ago. I was in tears as he started to describe getting to the death zone and losing a friend climbing Everest. I mean, it was heartbreaking. I was literally just sitting there at Aberdeen, just tears coming down my face, and then I think I ran out because I'm rock hard.
If they lost the bowels, John, you would have been
I mean, it was seriously emotional. It was just amazing. The future's negative 0.8% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Vladimir Putin is suspending Russia's observation of the new START treaty with the U.S. That's a blow to the last accord limiting their nuclear arsenals. In his State of the Nation address, Putin also warned the U.S. and its allies not to provide Ukraine with long-range missiles. China is now seeking to convince the world it's a neutral actor that can help end the war in Ukraine. That's coming a year after it declared a so-called no-limits partnership with Moscow. Chinese State Councilor Wang Yi is set to visit Russia after floating a fresh peace proposal to end the conflict. The U.S. has disparaged China's efforts. In the euro area, business activity rose at the fastest rate in 9 months in February. That's raising the likelihood that the bloc can avoid a downturn this quarter. Both France and Germany returned to growth after likely pullbacks in January. Shares of Credit Suisse hit a record intraday low. Reuters reported that Switzerland's financial regulator is reviewing comments made by the bank's chairman, Axel Lehmann, on outflows having stabilized. But results later show that outflows were tens of billions of dollars continued. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
Some higher inflation numbers for January. I don't necessarily think that that breaks the trend towards disinflation, but I think it reinforces the idea that the Fed still has work to do, and so we think another 75 basis points from here with no cuts until 2024 seemed like a more likely outcome.
Jan Hatzius there, the chief economist at Goldman Sachs, looking for a higher terminal rate in the last week. That move from him coming after better data in America. CPI and retail sales. CPI last week feels like a month ago. I mean, it really does. Welcome back after a long weekend stateside. Equity futures look a little something like this. Equity futures on the S&P, negative 0.75%. The earnings this morning not helping out the equity bulls, that's for sure. Home Depot a little bit earlier. They went first at 6 a.m. Eastern time. They forecast a decline in full-year earnings per share. And an extra spend on the labour story, increasing hourly wages for sales staff and a tight labour market. That's going to cost them $1 billion. That stock's negative. Home Depot down by 3.9%. Then Lisa, Walmart out about 50 minutes or so ago. Initially, first blush, first read seemed okay. Bit of a pop higher, and then reality strikes. Walmart down by about 4%. Talk to me about that reality.
Fourth quarter, fantastic, beat expectations. The biggest sales volume month in December in Walmart's history, and then the projections forward. A disappointment in 2023, a disappointment in 2024, with the CFO saying, we feel good about how the core business is operating, but we're being cautious with the macroeconomic outlook. How much do we continue to hear this? And what is that macroeconomic outlook? Is it consumers pushing back on some of the price increases, or is it actually a deceleration in purchases because of the savings coming down?
Lisa, you sent me the quote from the CFO. Tom, there's a lot of unpredictability around what's happening. I mean, yeah, that's for sure. The stock's down 4%.
Well, it's down 4%, but I'd say they're within a zone here. And the question is, do they come down to the support that was seen in October? This is something we love to do at Bloomberg Surveillance, and that is talk to securities analysts with esteemed experience. She goes back to Lehman. Karen Short joins us now with Credit Suisse. To say she's an analyst barely describes the trophies on the mantelpiece, including the very challenging Starmine Awards. Karen Short, thank you so much for joining us today. I want to start at the top of the income statement. When you look at unit and price dynamics at big retail, what do they look like?
Hi, thanks very much for having me. Well, I mean, I think, as you said, Walmart, this is one of the Walmart's better quarters on top line. The issue is flow through, really, on bottom line, and then that translates into the implied guide for the P&L for calendar 23. I mean, I think, you know, we have two of the big box retailers out there today, this morning, Home Depot and Walmart. Slightly different tales on retail. Walmart's clearly seeing trading in, but Walmart's clearly also seeing a higher cost to serve, as is Home Depot. And that's the biggest question is these essential retailers that have all benefited for the last 3 years. What is the sustainability on the P&L on actual operating profit margins relative to top line growth that they've gained and sustained? And it just appears that it's a higher cost to serve.
Do they use traditional retail management practices to adapt and adjust, say, into the back to school holiday season? Or can Karen Short say this time is different for big box retail?
I personally think this time is different for big box retail from the perspective that, you know, we were very neutral on almost our entire coverage universe when we initiated in December. And I think the issue is that some investors believe that the top line just will naturally flow through to a higher margin structure. And I don't think that's the case. I think the problem that retailers are going to face is that it's just a higher cost to serve, and margin structure may be just very similar to pre-pandemic levels on a much higher sales base, because costs keep flowing through. And case in point, you know, Walmart called it out obviously earlier prior to reporting on labor, and Home Depot did today in terms of their $1 billion investment in labor. Cost to serve is just going up, and margin structures may not be any better structurally than they were pre-pandemic, despite, you know, 20, 30, 40% sales improvements per box, depending on which retailer you're talking about.
Is this a story that really goes across the retail sector? Are you basically seeing the same margin pressures in Walmart and Home Depot, or is it more in Home Depot, less in Walmart? Do you expect it to not necessarily be consistent throughout the retail complex?
I don't think it's consistent. I think what you really have to look at is some retailers really leaned into investing during their sales gains. So Tractor Supply, for example, really leaned in and did not flow through margins. They invested, and their margin structure hasn't really changed. And I'm talking about operating margins when I say margin. Didn't change much, even with a much higher sales base. Other retailers, and I'm not saying this about Walmart and Home Depot necessarily, but other retailers definitely harvested. And I think what's catching up to many retailers is you should never harvest your sales gains. You always have to reinvest. And the better retailers have reinvested. I mean, Walmart clearly has reinvested in wages. They announced that several weeks ago. Home Depot just announced another wage investment. But, you know, I think retail investors are going to be shocked by the fact that, you know, that those massive margin increases across much of retail are just going to be completely imploded and probably even be down relative to pre-pandemic levels, because costs to do business have gone up. and sales are, maybe higher, maybe not, depending on the retailer.
Well, Karen, let's talk about that. So the cost to serve is going up. Got it. Margin structures won't be any better than pre-pandemic. Got it. They might be worse. Got it. Let's just lean on something else you said. Whether it's coming off a bigger or smaller revenue base. Karen, what are the retailers you think around there that can offset some of that margin pressure with just better top-line growth?
I mean, obviously, so my coverage is essential retail, so it's, I can't comment across much more discretionary, but within my coverage, I mean, I would say that the club stores, so like if you take a Costco and a BJ's, their deleverage and or leverage points are so much lower because their fixed costs are so much lower. So like a Costco and a BJ probably has more ability to retain margin improvement. But the rest of the retailers, I think you have another investment cycle coming. I mean, I think you have that for the dollar stores. Obviously, we just heard from Walmart and Home Depot that they will have that. I mean, I think you'll probably hear that from Target. I think you could hear that from Best Buy. I just think across the board, there is another investment cycle coming. And I don't think that you could I don't think I could point to many retail names that I cover that will have up EBIT or up EPS, even if sales are flat to slightly up.
Karen, this was amazing to catch up with you. Thank you. Karen Short there of Credit Suisse.
Thanks so much.
Just a snapshot of retail and the epicenter of it, that line that popped up a couple of times in that conversation, Lisa. The cost to serve is going up. The cost to serve is going up.
We're seeing that with wages. We're seeing that with all the potential back-end aspects, whether it's delivery and the trucking and whatever else. She also said there's another investment cycle coming. And this is sort of the clash here of the economy and the market. On the economic level, everyone was asking companies to invest more, to pay more, and suddenly that's going to fuel more spending power and more momentum on the consumer side. On the flip side, it's going to perhaps be at the expense of margins, and so at that point, can you see a negativity for a market story while it's a positive for the economy?
You're right to make that distinction. I think it's the important one. I was thinking of the same thing at the same time, Lisa. Tom, this is the story. If you're President Biden, you probably like what you just heard.
100%.
If you're long the equity market, you probably weren't too thrilled about it. And I'm sure that at this point, the president cares more about that than he does about what people along the equity market, Tom, are thinking about.
Can we see beyond whatever the outcome as inflation is to some kind of new normality of 3% or dare I say 2% inflation? If we get the rate structure down, maybe we don't get back to what we knew in 2019, but we get to something new, sort of kind of like 2019. How does retail adapt? They've adapted every single cycle.
You need a labor market economist to answer some of these questions for these retailers right now. The cost of serve's going up. Why? Because they think the labor market's really tight. Do you think that loosens anytime soon?
Doesn't seem like it.
3.4%?
I mean, not from what we're watching. And if you take a look at real wages, they've been pretty deeply negative for a number of years since the pandemic, not just in the U.S., but around the world. So there's still catch-up. If there's a tight labor market, people will demand more just to keep up their quality of life.
I partition. There's different parts of the labor market. There's, somebody had a great headline out that it's a rich session. I saw that this weekend. Somebody had it in the New York Times or whatever. But every single partition's different.
Some people out there are so brutal. I've just got this email. Karen Short at Credit Suisse. Can you find Karen Long, please? Isn't that great?
That is.
I'm sure that's not the first time she's heard that joke.
No.
Right? Futures negative 0.75% on the S&P. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002. But the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Conversation is shifting. Are we actually getting a re-acceleration instead of a slowdown at all?
I think it's going to be a year where we frustrate both the Bulls and the Bears.
This is a very uneven recovery.
Focus on quality. Focus on the companies that can manage margins. The story of the year is wages.
I'm a FOMO guy. I don't want to miss out on what will ultimately be a nice recovery in these markets.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Welcome to a Tuesday, a 4-day work week around the gloom, the death zone that we are all in, and maybe the optimism forward. Edward Hyman with us tomorrow. He'll bring us some optimism, no doubt. But what we've got now, it's a toxic stew, John, that I've heard for the last 2 hours.
That's a new one. Adding to that toxic stew or brew, whatever you want to say, Mike Wilson and Morgan Stanley thinks we're at that so-called death zone. There's no oxygen up here. This equity market's going lower. The Fed pause pivot's not coming.
Kind of makes forget.
Heard from Mislav Matejka of JP Morgan that said even if the Fed pivot did come, it'd probably be because the data's bad, and that's not a reason to buy either. Bottom line this morning, data's good. Yields are up. Data's better in Europe.
And life goes on, and I really heard that from Linda Dissel. I mean, the basic idea, she mentioned malaise. It got picked up on Twitter a little bit, the Dissel malaise. There's a huge uncertainty from the death zone to the optimism of the Uber bulls to the malaise of the moment.
Lisa nailed it as she always does, Tom. There's a difference between a better economy than expected and a decent equity market. And picking up on that story, the perfect case study for that conversation this morning, Lisa, is what's happening with Walmart and Home Depot.
I couldn't agree more. Their sales did phenomenally, in some ways recording better than expected sales numbers on an absolute nominal basis, but the margins not there. Expected to see more margin compression going forward. How much does this really shape the narrative? They cannot pass along the costs of the investment they have to do to keep workers and to keep investing in their infrastructure.
I'm looking at the whole thing, and it's a drama. Of course, we saw this with President Biden in Poland this morning as well. I think underplayed here, and John, you mentioned this earlier, the better tone out of Europe, the move forward with great uncertainty, and the maximum uncertainty this morning came from Mr. Putin in Moscow in his lengthy speech. That's been underreported today, and how that affects the earnings and financial tone.
Yeah, we've got to talk about the economic data too. Just a scheduling note, I guess. No payrolls Friday, next Friday. It comes on March 10th.
Way late.
I believe,
Yeah,
so a little
way
bit
late.
later than
Wicked late.
anticipated.
Wicked
If you want a source for volatility in the next 24 hours, maybe it's the Fed minutes. And I wouldn't typically say that. They come out at 2 p.m. Eastern time tomorrow, Tom. Is this going to be a platform for the doves or the hawks? If you'd asked me that at the last news conference when Chairman Powell said, look to the minutes, I would have said maybe that's a platform for the doves, because that was in response to a question about a Fed pause. And now you've heard from Bullard and Mester, non-voters but are heard in the meeting, talking about the prospect of 50. So does that come up? Does the conversation about financial conditions come up?
Listen to you.
Because in the news conference, he's meant to represent the consensus on the committee, and let's hope there is one for him to communicate for his sake. But does that come up in the minutes in the same way it did in the news conference, Lisa? Because in the news conference, he basically didn't really push back at all.
No, but he did say, read the minutes, basically saying, this is where we'll outline what we really think. How much do they massage the minutes to have a different message
Oh, here we go.
than they would have had? No, because they can really give some guidance through the way that they characterize the discussion. I'm serious.
Me.
Well, okay, on one hand...
Post-meeting massaging of the meeting.
Well, it's just to sort of give a message that perhaps is more hawkish than how he came off, because they can give a different tone if they see the facts as somewhat different now than they were then.
You think that Chairman Powell turned around and said, redact that?
I'm not suggesting that they're going to lie or anything.
We'll ask Mike McKee.
But they can emphasize certain points more than others based on how they see the market, how they see the conditions. This is part of their communication strategy.
I think you're way overanalyzed. I'd go to Hotsias and what you said to Bloomberg.
Literally an
You're
entire
25. My question is, I promised you I'll read the minutes, but John, do I read the minutes or do I watch Leipzig Man City?
The big games later, Tom. Liverpool, Real Madrid.
This is a huge deal.
That's a proper match.
What is it like to have one of the great European teams visit, a great stadium of Premier
Like Anfield.
League? What's it like? What's the body language
Anfield
like?
is a very special stadium, and a stadium that a lot of people fear, particularly at the beginning. They all sing that song at the beginning in Anfield. Real emotional stuff. Teams don't like going there. They don't like going there. And I think that becomes quite psychological for the visiting team. They convince themselves that it's not a great place to go, and then they underperform, but they don't like going there at all. For that matter, Tom, I wouldn't like going back to the Bernabeu to play the return leg either at Real Madrid. So it's going to be fascinating to watch that. That's a repeat of the final from last season.
Yeah, well, we'll have to see. Our guest here is of value. Lee Farage has a lot of experience, and John, he's riveted on Liverpool today. I mean, just to see what they do. But why don't you bring him in? What I love about it, he's looking at this year as an anomaly, and I think that's really interesting.
Well, let's talk about that. Lee Farage joins us now, the multi-asset strategy head over at State Street. Lee, why are you looking at this year as what Tom called an anomaly?
Well, I think it's going to be, it's going to be an unusual year, and I think the market's starting to get to grips after the payrolls number and the retail sales and the CPI. The economy is going to stay strong in the first half of this year, probably into Q3. The consumer in the US is still in a good place. Everyone's still recession talk, soft landing, et cetera, et cetera. But the point is that US consumers are not really being hurt by higher rates. We have 91% of mortgages that are 30-year fixed. Right? So in other countries, as rates go up, that hurts the consumer straight away. What we're seeing coming through on the data here, it's not happening here, particularly when you have such a strong labor market. And this is a real problem for the Fed.
Well, I mean, Lee, what's so important here is then how do we participate in the stock market? Whether you're doing it through index funds or active management or individual stock selection, how do you participate given the death zone that is either here or out there somewhere?
Quite honestly, Tom, right now, I wouldn't participate. I mean, that's, my view is that I would agree. I think stocks have got ahead of themselves. I think they priced in that Goldilocks soft landing. Fed are nearly done. We're cutting in the second half of the year. It's nonsense. We're not. Right, so the Fed is going to keep going. I agree. I think they'll go through to June, maybe even July. Can't be ruled out. So no, I wouldn't be participating in stocks right now. I think we've had what I think was a significant bear market rally. I would not rule out a return back to the lows.
Wow. Lee, this is an agreement that, or an idea that a lot of people can get behind. One thing, though, that you do say that is a bit counter consensus is that you think the dollar could strengthen considerably from here. How much of a pain trade could that be, considering that everybody said Europe was the place to be this year?
It could be a significant pain trade. I mean, I think, look, as I said, 91% U.S. mortgages are fixed rate. That is not true in Europe. It's not true in the UK. It's not true anywhere else. So while others fall by the wayside as consumers take the hit from higher mortgage payments, higher debt payments, and we see weak data elsewhere, I really think you're going to see separation in the US, and it's that will drive the dollar higher. So it is going to be a pain trade. Look, back in October, we saw a massive overweight in the dollar. Looking at our indicators now, the overweight in the dollar is about a third of what it was in October for institutional investors. So that means there's potential to rebuild those dollar longs. And as you say, it's a huge consensus to be negative the dollar now. I think that's going to be really, really painful over the next 6 months. I think we will see the DXY rally back, maybe not to the highs we were at, but I can see the euro back in the low, 101, 102, sterling back below 110. I think that is perfectly feasible in the next 6 months.
Does that make U.S. assets more attractive than, say, in Europe or even emerging markets? In other words, is this going to be a reversal of the entirety of the first month of this year?
I think it is. EM is another area where everyone's been desperate to buy EM. And like selling the dollar, at some point that will be a great trade. Buying EM at some point will be a great trade. But everyone's gone in very, very prematurely on the basis of that Goldilocks scenario, which is starting to unravel, but people are still maybe January was a one-off, maybe the weak data's coming. Well, if it doesn't, then all those people piling into EM are going to get hurt, I think. So, look, at some point, EM's going to be a great trade. It's just not yet.
Ali, that number, 90%, are paying fixed rate mortgages, and the duration of them, Lee, is so much longer than what we see in the UK and Europe. I mean, UK fixed, Lee, we're talking what, 2 to 5 years? Something like that?
At most, at most.
We're talking about fixed here that are going for decades, Lee, and I just wonder, what are the consequences of that? Just the generation of people locked into a mortgage, they're just not going to move, are they?
No, I mean, it does mean that people don't move. But what it means is the Fed's job is that much harder. Even if you look back to the early 80s, the last time we had, the inflation issues we've got now, only around 50% of mortgages were 30-year fixed back then. The rest were sort of arms or floating. Now you've got 91%. And not only that, a lot of people refinanced during the pandemic at much lower rates. So if you look at mortgage servicing, debt servicing costs, they are lower now than they were before the pandemic. So even with rates where they are, even after 450 basis points of hikes, mortgage debt payments are lower than they were pre-pandemic.
So, Lee, when they say long and variable lags, do they mean like decade-long variable lags?
Well, this is the thing about the long and variable lags. The lag or the impact is going to be much more drawn out because you're not hurting the majority of people. So you hurt new activity, new home sales, new car sales, etc. But if you have your house, you have your car, all on fixed rates, nothing changes.
Hey, Lee,
and that means it takes a long time.
Super smart, as always. Lee Ferridge there.
I've never heard him this gloomy. Is he this gloomy because
gloomy.
Liverpool's in 8th?
They're not doing well this year.
Yeah.
Do you want a prediction, Lee? Is Lee still there? Do you want a prediction, Lee, on Liverpool Real?
I think we're going to win 2-0.
2-0.
So specific.
At home.
See that he talks
what about the return leg? Is that including the return leg?
No, the return leg's going to be 1-1, so we will go through.
Okay, you advance. Good to know. All right. No bias here whatsoever.
Always trusted
Jürgen. Is that
Jürgen.
a red sticky?
It's a red headline.
Ferridge.
It's going to cross the Bloomberg in a moment. Lee, thank you, mate. Lee Ferridge there, State Street. On Liverpool, Real Madrid, a little bit later. And, of course, on this market. Those long and variable logs sound pretty long, don't they?
Don't get me going. This is out of Chicago years ago. I've always had trouble with it. What I would suggest there, I've never heard Mr. Ferridge that cautious, ever. I've never heard Lee Ferridge that cautious.
Getting gloomier.
Yeah.
The higher this market gets. What did Lisa say earlier? Can you help me understand how you communicate the difference between, skepticism and Armageddon? Was that it? No, it's not. Caution and Armageddon, of course.
Well, I mean,
thanks for the clarification.
That's been the notes. That's been the tenor of the notes. I'm not saying it. It's just,
not at all.
The death zone.
Down 8/10 on the S&P. This is Bloomberg.
Keeping you up
today with news from around the world. With the first word, I'm Lisa Mateo. Vladimir Putin is suspending Russia's observation of the New START treaty with the U.S. That's a blow to the last accord limiting their nuclear arsenals. In his State of the Nation address, Putin also warned the U.S. and its allies not to provide Ukraine with long-range missiles. President Biden is seeking dividends from his surprise trip to Ukraine. The president's hoping to rally new support for the Ukrainian efforts against Russia as he meets with Eastern European leaders in Poland. Shortly after President Biden's visit to Ukraine, the U.S. announced $460 million in new military aid. In Turkey, a pair of earthquakes rocked a southeastern province 2 weeks after major quakes in the same area killed more than 40,000 people. Monday's quakes killed at least 3 people and injured more than 200 others. Turkey's government has announced that it will start building about 200,000 homes in the hardest hit areas. Walmart came out with a profit forecast this year that fell short of estimates. That signals a cautious outlook for the world's largest retailer after last year's performance was hurt by a surge in inventory. Walmart says earnings will fall by as much as 6.2% in the current fiscal year. And Home Depot is forecasting a decline in full-year earnings. The outlook signals a slowdown in do-it-yourself spending at the home improvement retailer. Meanwhile, Home Depot is spending $1 billion to increase hourly wages in a tight labor market. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Earnings season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number. Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
This has quickly become just a really crappy business model.
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
I don't think they can get CPI to 2% without crushing the economy. But that's because 2% is not the right target for our economy. When you have so much stuff going on the supply side, you need a higher stable inflation rate, call it 3 to 4%.
Fascinating to hear those comments from Mohammed. It was great to catch up with him on Friday. Mohammed Al-Arian there, the Allianz chief economic advisor and Bloomberg opinion columnist, amongst other things as well. The story here essentially is that he believes the least worst option now that the Federal Reserve can take is just accept a higher inflation rate. Not because he thinks that's good, he thinks that's bad. He just thinks the alternative idea is even worse. Ultimately, you'd have to crush the economy to get down to 2.
It was a terrific interview, and I listened to it very carefully because he doesn't think it's a good idea to raise the inflation bogey, but there isn't necessarily a better option. And this really goes in the Adam Posen line of thought. Do they telegraph that, though, or is it just sort of accepted and they become more dovish? I'm talking about the Federal Reserve, as they see inflation come down, but maybe even not as much as they'd like.
Because they were so late, and he warned about it so many times. He also said that at the last meeting they should go 50, but they'll go 25, and the recent economic data subsequently maybe speaks to the idea that perhaps they should have.
You're starting to hear, though, more people, even people who thought of a softish landing and thought that there was this really significant disinflationary force like Jan Hatzius over at Goldman Sachs, start calling for potentially 75 basis points more of rate hikes or even another 50 basis point hike at one of the upcoming meetings.
Important. He echoed Greenspan in a measured way. And measured is different than the emotion of the jump conditions that are out there right now.
January changed the conversation. The economic data from January that we've witnessed in the last couple of weeks in February. We've said this a few times, Tom. We have the luxury of saying this. It's too early to draw conclusions. If you're in this market, you probably don't have that luxury. But we have to wait to see if February confirms what we saw in January. And March, for that matter, and April and May.
We'll have to see. Right now, just quickly a note from the wonderful Oliver Chen over at Cowen. He reaffirms an outperform on Walmart. His full note will be out here in a moment. This is a joy and is incredibly well-timed. He is with the Bank of England, or was with the Bank of England, and we're not going to ask him if the Bank of England is declaring victory. But Spencer Dale has a unique portfolio to bring to us today. It is not only his work in economics at Wales, Warwick or Warwick? Help me here. Warwick, thank you. Good. It's good to know that. But Spencer Dale also here with his work with the British Petroleum Group. Lord Brown has been someone that supported our economics for years, and we're thrilled that we can dovetail in what BP sees out there in energy with the heritage of British petroleum. I thought Oswald Clint at Bernstein was great on the day where BP said we're going to have to walk away from all that we did on Russia. How big is the turmoil right now in global oil, like a year ago when BP said we've got to walk away from Russia?
I think that the oil market remains very uncertain, but I think the biggest surprise over the last year is Russian exports of crude haven't changed. You look now compared to a year ago, they're pretty much unaffected. Where they're being exported to has changed very dramatically. A lot of it was going to Europe, and you've seen an almost massive shift away from Europe now, particularly with the ban, into India in particular and China. But overall flows of Russian oil pretty much unaffected.
Everybody has to lean forward when BP studies this, and you do this within your annual survey as well. What is the distinction we have to know about Mr. Putin and the cash coming in from his oil sales?
So I think we spent quite a long time thinking about how the war may affect energy markets. And I think the simplest way I think about this, if you sat in the ballroom of BP or in government officials around the world a year or two ago, all the conversation was about the importance of decarbonising the energy system, the race to get to net zero. That urgency stays, but the war has been a sort of collective reminder about the other things energy systems need to generate. So they need to give us energy security, and they also need to give us energy affordability. You put those three things together, so energy economists will often talk about security, affordability, and sustainability as the energy trilemma. You can't solve a trilemma, but the importance of the trilemma is you need to balance all three of those different elements if you're going to have a successful and enduring transition. And I think there is a danger that prior to the war, the world had come focusing on just one element and had lost touch on those other two.
We heard from Ed Morse of Citigroup earlier today, and he was talking about a pretty radical view that Chinese and global oil demand may be close to its peak and is probably on its way down because of the trilemma and how different economies are trying to solve it with other forms of energy. Do you agree?
So I guess two things about China. One is In the near term, everybody's been surprised by just the pace at which China's relaxation of the COVID policies happened, and so have revised up their views of oil demand growth this year. So a story, if you look at most people now, consensus out there would have oil demand growth of about 2 million barrels a day this year. Of that, around half of that is China, so they're massively important in the near term. The story, which I guess relates to Ed's piece, is when you think about energy security, countries worrying more and more about energy security, a natural instinct will be to say, I want to reduce my level of imports I'm making of energy, and instead boost my domestic energy. And the nature of that is most domestic energy from many parts of the world, including in China, is non-fossil fuels. It's wind, it's solar, it's nuclear, it's hydro. Most of the energy that you import around the world, particularly in China, is oil and gas. And so this one of the stories that we have in our outlook is we think the war is likely to accelerate the energy transition because of this energy security effect. Import less oil and gas, boost your domestic renewables, and that has a positive in terms of the energy transition.
It's such an important point when people look at commodities as almost a proxy for global growth. If the economy does well, supposedly oil prices should go up. If the economy goes into recession, oil prices should go down. Are you getting on board with the idea that oil prices can stay low even with a decent global economy because of all of these alternative forms of energy?
So I think one is those alternative forms of energy. We've also seen a key factor which I think helps to balance markets is what's happening here in America in terms of US tight oil, US shale oil, and the nature of those businesses. And at one point, they were able to sort of act as a moderating influence on oil prices. I think the nature of those business models, you guys I'm sure have talked about it a long time, has changed now. Far more focus on giving returns back to shareholders, reinvesting less, and as a result of which I think that's caused the sort of the price at which those rigs start to come on to be higher now than it was a year or two ago.
Spencer, where does coal consumption fit in here, particularly in Europe?
So I think coal consumption in the very near term has gone up, essentially as you've been scrambling around for resources. But further out, I think we're seeing a story in Europe of a mass movement away from that coal, and seen very significant reductions in sort of coal-fired power generations in the UK, in Europe, and I think that trend I don't think is going to go away.
There's three factors behind Europe's better performance. That's consuming less gas, bringing coal back online, and just the fact the weather has been milder. Do you see Europe being able to repeat that act next winter, the winter after that, the one after that?
And I think that's a key point, John, is the underlying story is still that the Europe and the global market is short of natural gas. In some sense, we got a lucky break this year because the weather was very mild. You come through next winter and there's no guarantee that's going to happen. And so that market remains very fraught. There is some signs, both in terms of the sort of residential heating and in terms of the way businesses are using natural gas in Europe, that's declined. And so some of that may persist. But that underlying vulnerability that Europe needs to import an awful lot more of its gas via global markets rather than via Russia means that shortage is there. And so prices today, we say, well, that's great. They've come down a lot. They're still double what they used to be. They're still roughly about 5 times higher than in America. And that's at a good time. And there's a risk that they can go higher if we see sort of cold winter next year.
We've got 40 seconds. You can do the Bank of England or Chelsea. It's your choice.
I think Chelsea is just a waiting game, and I'm fully behind the team, and I think this time next year I'll have a big smile on my face.
If John and I are there at Tots Chelsea here on Sunday, can you get us into the BP box?
I wish. I tell you what, if you were, I'd be fighting you first.
Okay.
Hey, Spencer, this is great. Let's do it more often. Spencer Dow there.
Thank you.
Of the BP Group, and formerly, of course, of the Bank of England. Equity futures right now down 0.9% on the S&P. In the next hour, we'll catch up with Stephanie Roth of JP Morgan, Tony Rodriguez of Nuveen, and Keith Lerner of Truist.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg surveillance, much going on right now at this moment in Poland, an historic meeting that harkens back to another time and place. The President of the United States with the allies of Eastern Europe. 1 year on in the battle of Ukraine, the war of Ukraine, I should say. This is an extraordinary moment for those on radio, the American flags front and center, with the red of Poland as well. Lisa, an important note of ally reaffirmation.
And as this happens, we haven't really talked about this. Vladimir Putin earlier this morning saying that he is halting a pact that he has with the U.S., with NATO allies, to allow investigators, inspectors in to observe their nuclear arsenal. And this just sort of highlights the growing fissure between Russia and the rest of the Western world.
The week is so important here that before we get to Mr. Giannone of Barclays, I thought that we should have Michael McKee in here. Not so much on Philadelphia Fed non-manufacturing. I don't see the data. Mike, correct me if I'm wrong. But far more importantly, on the week ahead. And Lisa mentioned she'll read the minutes. I won't. I have to watch Real Madrid play.
Just promise that you would.
But, well, you know, maybe I'll get to it. But there's PCE deflator as well. Are you focused on the minutes? Or are you focused on PCE deflator?
Focus more on PCE at the end of the week because it's about spending and it's about incomes and whether or not incomes have started to catch up with or are still way ahead of what the Fed wants to see. Spending, is it holding in there? It seems to be from the retail sales numbers. And then we get the inflation components of that, which are going to be really important. The PCE is, of course, the inflation index that the Fed targets. And so we'll be watching the headline number, but more importantly, the core services ex housing number, which is the one that Jay Powell has cited as telling them the most about the status of inflation in the economy.
Lisa, this is really, really important. I don't think McKee's ever done that, broken down services into something new. I mean, it's sort of, we're making it up as we go.
The super core, that's basically what you're talking about, right? This is the new measure that the Federal Reserve
looks at. The Fed is
at.
actually doing the super core.
Yes, they're called, super core.
They're looking at it, yes, because they think that services are where inflation's dangers are the greatest because the service industries are still having trouble finding people and therefore pay up for it and have some wage inflation issues. We saw that today with the Home Depot people talking about, you know, raising payments to people.
Futures deteriorate. You can see that on television, on radio. Let me tell you, futures negative 33, Dow futures, and then negative 300, down 0.9% on the Dow. Nasdaq down 1% as well, and the VIX expands out over 22 as it has all morning. 22. 0.36.
I do want to note that the Philadelphia Fed non-manufacturing activity did just come in way above where it was expected. And Mike, I'd love your just quick reaction before we go to our esteemed guest next.
Well, it's at 3.2 from negative 6.5. And while this is a sort of a tertiary indicator, people don't pay a lot of attention to it. What we've seen in Europe today and what we're going to be looking for later this morning in the United States is a rise in service industry measures for PMIs around Europe and the U.S. And what it appears to be is that with the weather as mild as it has been in many countries, there is more disposable income because people are not paying as much for utilities, and that's keeping service industry spending up. So that will be something interesting to follow. Remember, the Philadelphia Fed's manufacturing index took a real dive. So the fact that service industries are hanging in that area is good news for the economy.
In a 4-day work week, there it is, 3, 2, 1. In a 4-day work week, some people can't speak, but I'll try right now. It's important to readjust to the economic data that Michael McKee speaks of. Mark Giannani is hugely qualified, chief U.S. economist at Barclays, but far more, tours of duty with the New York Fed and the Dallas Fed as well. Dr. Giannani, thank you so much for joining us. When you were at Princeton studying with Blinder in the August people there were theories that you talked about. Is there an operative theory right now for Mr. Powell and the Fed?
Hey, good morning, Tom, and thank you very much for having me here today. Yeah, I think the Fed has increasingly used its tool of forward guidance over the past couple of decades and has become more adept about using that. And I think this is a theory that has been largely developed in those days at Princeton, as you mentioned.
Describe the Barclays glide path of supposed disinflation. Describe the glide path and the timeline of that glide path.
Very good. So we of course come down from very, very high inflation rates. We were running at like 9% CPI inflation last year. Inflation has come down quite a bit over the past year. We are now expecting inflation to overall continue to decrease throughout this year, despite the fact that the last reading have been a little stronger than expected. And we expect the PCE deflator to still show some robust gains later this week. But we expect inflation to year-on-year come down to around 3% by the end of this year, with core a little higher and headline inflation slightly below 3% on a PCE measure.
Mark, you said that the Fed seems to be gaining little traction against strong labor demand in one of your recent reports. What do you suggest they do to gain more traction over labor markets?
Well, they really have a blunt tool here, which is the short-term Fed funds rate. They can increase that a little more. We expect, in fact, that they're going to increase the Fed funds rate another 25 basis points at their March meeting, that they will continue to raise it another 25 basis points in May, and likely again 25 basis points in June. So, in total, bringing another 75 basis points of tightening in their with their short-term Fed funds rate. In the background, of course, we have the balance sheet continuing to decrease. But much of the control of the economy is really happening more through the Fed funds rate at this point.
You talk about the blunt tool, and it can have pretty blunt and painful consequences, particularly for an employment market that takes a while to return to its full force once it is really beaten up. And I am wondering whether you agree with Mohamed El-Erian when he said, basically, it's not going to be worth it for the Fed at this point to do what it takes to get inflation back down to 2%, and they're probably going to have to settle at a higher rate of, say, 3%. Do you agree?
I feel pretty strongly that the Fed will want to bring inflation back to 2%. They are determined to do that. It's going to take a little longer, but they are absolutely determined to do that. I don't think that they will settle for 3% inflation. And the reason for that is that they've really have benefited tremendously in this recent episode from the fact that inflation expectations have been anchored at 2%. And if they were to deviate from that, if they were to give up on that, on achieving 2% over time, most likely inflation expectation would be drifting up, both across financial markets, household firms, professional forecaster would be revising the inflation expectation up, and that would be extremely costly for the Fed over time.
Mark, a couple years ago, a good number of years ago, with the wonderful Jean Bovin over at BlackRock, I assume the two of you at Princeton at the time, you wrote a paper on the disaggregated. To me, this is a key point coming out of a natural disaster, a pandemic. Do we aggregate in our analysis, or are things so messed up that we have to disaggregate labor, disaggregate monetary policy, disaggregate the equation of GDP? Do we disaggregate here, or do we sum up as we're used to doing?
So ultimately, when we think about the Fed in particular, I mean, they are interested in bringing the overall inflation, meaning headline PCE inflation, back to that 2% target. But in order to understand the dynamics, we have to, of course, disaggregate. And this is particularly relevant in the most recent episode, where we've had services and goods evolving in a very unusual way due to the shock that hit the economy, with services prices initially declining, but then increasing more rapidly, and goods prices doing the opposite, falling very, very sharply initially, and then rebounding very, very strongly due to the supply chain issues. So we have to go look under the hood and look at the details of the disaggregated component to understand really the dynamic for the aggregate as a whole.
When you disaggregate, perhaps we'll find rolling recessions in different sectors that add up to perhaps less robust growth than you might expect, but not a wholesale overall recession. Is that your outlook? Do you still fall into that despite the blunt tool the Fed has and the desire to get inflation down to 2%?
Well, that's a very good point. So we've seen the tightening in financial conditions, the increase in rates having a very rapid impact on the housing sector, reducing housing demand last year, having some significant impact on starts, on permit issuance, and so on, and affecting activity in the residential sector. So we've seen that very quickly. But I think underlying your question is the fact that more broadly, we haven't seen a recession. We see consumption still growing very, very strongly, very robustly, and that consumption is actually fueled by this very tight labor market that generates a lot of income and fuels consumption. So we expect that to eventually slow down as the rates go up, as the Fed continues to tighten its policy. We've seen indication from the survey of senior loan officer opinions suggesting that there is tightening in credit, continuing tightening in lending standards. So we expect that to overall slow down the economy more broadly, and to result in mild contraction in economic activity later this year.
Dr. Giannani, thank you so much. He is with Barclays this morning. Lisa, I think that's so important, and it's just another research paper along the way. But when he and Bovin were students at Princeton and just out, whatever, this idea of should we look at these statistics all in or disaggregate is a huge question right now.
Especially because we are seeing these rolling recessions. The goods economy is completely distinct right now from the services economy on many levels. You look at very different patterns, a very different cycle, and this is because of the pandemic. This is because of a lot of the purchasing power that was brought forward. But how do you parse that out if you're looking at an overall figure?
You've gone to the heart of the matter, which is if you parse out goods dynamics and services dynamics, every viewer and listener knows we're living service inflation. We don't need to be lectured on that. The issue is goods is turned with a vengeance, read David Rosenberg, and services we've really yet to see the evidence of a service inflation turn.
And now we're even seeing some reinflation in certain areas of the goods side. So again, it's sort of how do you game this out? And then you throw on an energy situation. I don't know, a lot of uncertainty.
We continue. Futures deteriorate -34. The 10-year yield 3.88%. Higher yields this morning. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin had a warning for the U.S. and its allies in today's State of the Nation address. The Russian president threatened a backlash if they supply Ukraine with long-range missiles. Putin vowed to press on with his faltering invasion. He also said Russia will suspend its participation in the New START nuclear weapons treaty with the U.S. China is urging the world to stop saying that Taiwan is next after Ukraine. Foreign Minister Qin Gang says that certain countries should stop fueling the fire by blaming China and saying, quote, Ukraine today, Taiwan tomorrow. Beijing has been trying to distance itself from Russia and portray itself as a neutral force for peace. Goldman Sachs sees the Federal Reserve raising interest rates by a 1/4 percentage point at its March, May, and June meetings. The bank's chief economist, Jan Hatzius, told Bloomberg that he also thinks there will be no rate cuts until 2024. Hatzius cited higher inflation numbers for January. In the euro area, business activity rose at the fastest rate in 9 months in February. That's raising the likelihood that the bloc can avoid a downturn this quarter. Both France and Germany returned to growth after likely pullbacks in January. And Microsoft is heading into a showdown with EU regulators over its $69 billion takeover of game maker Activision Blizzard. The software giant says the deal will lead to more competition for gamers. At the same time, Microsoft is pledging to show willingness to address antitrust concerns. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We are concerned that China is considering supporting Russia's war effort in Ukraine with lethal assistance, something that we're watching very, very closely. This would be a real problem for China in its relationships with many other countries, not just the United States. So we hope and expect that they will forbear from going down that road.
The President of the United States is in Poland. The Secretary of State of the United States, Antony Blinken, speaking on China this morning in his difficult meetings that we've seen for it. It has been an eventful day. Our Anne-Marie Horton, our chief Washington correspondent with the President in Poland. We have seen the pageantry there, and of course this meeting of the 9 members of Eastern Europe. But the focus must be, and maybe, Lisa, do you agree, off the radar a bit, is this China-Russian U.S. axis. It's just not being discussed enough as a sum total.
I would agree. That was the one thing that caught my attention over the weekend. That was the most concerning, that suddenly this is an even greater rupture between the U.S. and China that raises a new specter and a new tension. As John put it, the potential for a proxy war being played out in Ukraine.
Some of the perspective on this with AGF Investments, the chief U.S. policy strategist, a morning read for All in Washington, Gregory Vallier. joins us this morning. Greg, it's real simple. As you know, the first year of a war, there's a tone, and then the second year of a war, it's different. What do we do on spending, on defense spending in the second year of any given war?
Well, it suddenly is a much more relevant question, Tom, because everyone had assumed maybe defense wouldn't get as much as they have in this new fiscal year. They're up to $850 billion. They got a 10% increase. And lo and behold, we heard comments from Blinken over the weekend and hints that China may aid Russia. If that does occur, I think that it would be a serious rupture, and I think it would lead to still another big chunk of defense spending. We might go up another 8 or 10%, focusing on shipbuilding, focusing on the South China Sea.
You know, well, that's right where I wanted to go. I hope I've got the spelling right there. Correct the spelling, Amy, if you would. My fractured spelling, Greg, as you well know. What it comes down to, and to tie it together, is Ukraine, the Philippines, and China. And that we've decided we're going to build 4 bases in the Philippines. The New York Times had an article on this weekend. I mean, the U.S. is projecting towards China, aren't they?
Yes, and I think that any chance that we would have lifted some of the Trump-era sanctions is gone. In fact, I think there's a chance we could have even more sanctions against China.
What did you make, Greg, of what Tony Blinken said? I mean, basically, they are seriously concerned that China could be actively considering sending more support over to Russia, and that includes perhaps surveillance support. This is sort of on the heels of the whole balloon episode. What do you read into that?
Well, I think it's ominous. I would worry if we went down that road. And by the way, the North Koreans sending missiles over northern Japan isn't even on the front page. That's in on the back page. So there's so much tension right now. I see some people in the U.S., some Republicans saying we can't spend that much more on defense. But I think Biden has the votes. I think he has the votes in the Senate. He's got enough Republicans there to get him a big increase in spending.
This could potentially go to expanding a presence in the Philippines. This could potentially go to expanding a presence with a number of allies in the Southeast Asian region. But this also speaks to what is going to be the relationship between business and China, and also with the U.S. and Germany, because Germany depends a lot more on China. Do you have any visibility into, particularly on the business side, whether they're going to be more aggressive, the U.S. administration, on pushing back in expansion in China?
My sense, Lisa, is that they will. It's maybe avoidable, but I think U.S. businesses are going to have to anticipate a much more hostile climate for the foreseeable future.
I look, Greg, and of course it's all foreign exposure with the president in Poland right now meeting, but I think we need to bring it back. How good a week did Governor Haley have of the South Carolinas? I mean, she made a splash X number of days ago. What is the now what for the candidate Haley and the other candidates ready to jump in?
That's a good question, Tom. She had a great opening day. As the week went on, there were more people picking at her record and inconsistency on racial issues. But that said, I think she's a fresh face. I think she's going to have some traction here over the next few weeks, but there are more people coming in, whether it's Pompeo or Mike Pence. Right. I think she doesn't get to have the stage all to herself, and it now looks like DeSantis is really gearing up. He had speeches over the weekend against crime, and now his comments on not spending as much money on Ukraine. So it's a crowded field.
Do you see any evidence that the former president, Mr. Trump, has lost his audience? I don't see any evidence of that. Do you?
He's lost a little. What surprises me is that he's been relatively quiet. No nasty nicknames, no outrageous, bombastic statements. By Trump standards, this has been a kind of a slow period. You wonder about why. I think it's temporary. I think he's still in it to win.
And on the Democratic side, I mean, here's a president, to be kind, more than active, with the symbolism that we saw in Kyiv this weekend and what we see in Poland now. What does he return to? An announcement well-timed?
I think he'll wait till April. That seems to be the consensus, Tom. He had a great weekend. I mean, you got to give him credit for a chutzpah. So I think he clearly is the nominee. There might be a fringe candidate or two, but barring some kind of a health issue, the nomination is his.
There's been a number of critics who have said that perhaps President Biden's focus isn't focused enough on the domestic sphere, particularly what happened in East Palestine in Ohio, and that he is too internationally focused at a time where there are all of these major conflicts. Do you think that that could hurt him as he becomes potentially the next president yet again?
Well, it could. I mean, obviously, he wants to get inflation even lower and get the economy stronger. He doesn't want to see the Fed raising rates too much more. But I would say this is going to be a year, guys, where geopolitics dominates. It will be the big story. It will eclipse most economic issues.
And you think that it's going to be more on the spending on defense and on the sanctions front, not necessarily on the actual hot war aspect of it. Is that correct?
Yeah, and again, I think that the defense budget is probably going to get another 8 or 10% in this new fiscal year budget.
Greg Valliere, thank you for the brief. Just hugely valuable on an eventful Tuesday with AGF Investments, Gregory Valliere, this morning. Lisa, this whole foreign-domestic dichotomy as we shifted there from what we've seen in China, what we've seen in Russia and Ukraine and Poland this morning, over to who's going to run for the Republicans, just shows you the abruptness of the moment.
The fact that Greg Valliere, though, is basically saying geopolitics will dominate is really telling to me, because what we're seeing right now is the kind of tension that we haven't seen since the Cold War. And that's the language that they're using right now, with China saying people are acting like a Cold War, and Tony Blinken coming out over the weekend and saying, no, we have no intentions of going back to a Cold War type of mentality. But this is sort of, these are the stakes that people see right now.
What's interesting to me, and to your great observation, is the cardinal rule is geopolitics doesn't matter for the American electorate as they move through October, after Labor Day through October towards November. But then there's one huge exception as we celebrate the life of President Carter. He's grievously ill, resting at home in Plains, Georgia. And that's all great, except we have to remember Mr. Carter was overwhelmed by international relations when he, in that huge landslide defeat to Ronald Reagan, having to do with the terrible Iranian hostage crisis.
Well, you think about the current moment and where we are with respect to an increase in a fissure between U.S. businesses and China. What does that do for inflation? What does that do for some of these business models in some of the preeminent U.S. companies that are intimately connected with China?
Are we going to hear a different story tomorrow from Edward Hyman of Evercore ISI? We heard a lot of caution today, I think, led by Mike Wilson, the 3 rate rises of Goldman Sachs as well.
There are plenty of bulls out there who say this is the beginning of a bull market, that we're looking at real sustainable growth. Yeah. And I just think that there is a distinction between the economy versus markets. And for a long time, it was markets over the economy. And is that shifting a little bit as we enter an inflationary
so
period?
Much for a slow 4-day work week. It is not slow. These markets are shifting here and deteriorate. S&P -37, down -333 points. The VIX ought to stick 22.40. The 10-year yield now up to 3.89%. Stay with us. This is Bloomberg Surveillance. Good morning.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
Today, what are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Welcome back. As you were, yields up, stocks down. We're down 0.9% from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, equity softer as Walmart forecasts a rocky year. President Biden speaking in Poland after visiting Kyiv, and Credit Suisse stock hits a fresh all-time low. We begin with the big issue, the bearish roar growing even louder. Morgan Stanley's Mike Wilson delivering another warning. The bear market rally that began in October from reasonable prices and low expectations has morphed into a speculative frenzy based on a Fed pause pivot that isn't coming. JP Morgan's Mislav Matejka elaborating on that, writing, we could indeed see a Fed pivot, but perhaps only in response to a much more problematic macro setup than the market is currently looking forward to. While Mohamed El-Erian says the Fed can't hit its target without crushing the economy.
I don't think they can get CPI to 2% without crushing the economy. But that's because 2% is not the right target for our economy. When you have so much stuff going on the supply side, an energy transition, a change in the supply chains, geopolitical issues that come onto the supply side, the way the labor market functions. It's a long list of supply issues. You need a higher stable inflation rate, call it 3 to 4%.
Joining us now to discuss, JP Morgan, Stephanie Roth, Nuveen's Tony Rodriguez, to both of you. Thanks for being with us. Stephanie, first to you. The S&P 500 year-to-date up 6%. The Nasdaq up close to 13%. To build on some of Mike Wilson's work over at Morgan Stanley, just how much oxygen is left up here?
Yeah, I think the risk is very much to the downside from here. The market seems to be pricing in this really optimistic outcome that I don't think is right. I think the narrative right now is wrong to some extent. There's this excitement about the data that we've seen, that payrolls came in really strong and retail sales came in really strong. A lot of that is seasonal noise, and we have to look through that to some extent. And what we're seeing is inflation that's sticky, and an economy that's showing some cracks beneath the surface. So from our view, we do like core fixed income here. We think REITs should eventually come back down. And we're cautious about equity risk at the moment. We do think that there could be some more downside.
Tony, my head is spinning. We've gone from soft landing to hard landing to no landing at all. Which one is it?
Well, Jonathan, you're not the only one whose head is spinning. Clearly, there's a lot of volatility here in the data. Our view, though, is really that what's happened is that we're clearly entering the year a bit stronger than what we had expected. So whereas we were talking about, say, a mild, shallow, short recession in the middle of the year, that's getting pushed out as we're seeing greater resiliency in the job market with the consumer. But it hasn't really changed the overall narrative that we still expect to see a moderation in growth as we move later in the year. Our shallow recession call may have to move to a soft landing call. It certainly has to be pushed out later into the fourth quarter, maybe even early 24. But overall, we're still expecting to see that moderation in growth, a slowdown in inflation, but we certainly agree that it's going to be sticky. So we're not hitting the 2% target, certainly not this year, probably not even in 2024. But the base case for us right now is a either soft landing or very mild recession, but we're pushing that out later this year to early next.
What totally upended all of this was the January economic data, whether it was payrolls, CPI, PPI, retail sales, all coming in higher, punchier than expected, and all of a sudden people are scratching their heads. Stephanie, I think you touched on this, and this is important. The question is whether the February data confirms January, and to what extent within that January data is there more noise than signal? Which one is it for you?
I think a lot of the noise that we saw in January was exactly that. It was noise. Payrolls are incredibly difficult to seasonally adjust around January, especially in the post-COVID period. Same with retail sales. Every January, on average, you have sharp job losses. So on average, you have about 3 million job losses. This time we had 2.5 million. So it's really, really difficult to decipher within the seasonal volatility. So I think the trend is that the data are certainly more resilient than many had expected, but it's not this acceleration that the January data would point to. So February, we should see a give back in a lot of the data.
Tony, this is the problem. We're told that we're data dependent. The Fed's data dependent. We should be data dependent. How dependable is the data?
Well, Jonathan, it's certainly going to be volatile. So, but our view in agreement really is that we do need to see confirmation in the February data and probably even the March data as we move beyond the next Fed meeting. Because right now the question mark is just, is the Fed going to have to go the next 2 meetings, 3 meetings, or even further? Our view is they're clearly going to go the next 2. We don't think they step up to a 50 basis point pace. And we do think that the June meeting is now significantly more in play than it had been. But our view is still that we are going to see that moderation. You're not going to see a 6-handle Fed funds rate unless the January data, in fact, is a trend that's being created for the U.S. economy. Our view, though, is that there are those seasonal impacts that hit those numbers, and we should see some moderation as we see the February and then the March data.
Yields are up this morning by 6 basis points on a 2-year. Your 2-year right now, 468 on a 10-year, up 7 basis points to 389. A little bit later this hour, we get US PMIs. The PMIs out of Europe this morning, better than expected. Services improving. Mike McKee, the next stop for the Fed speak, I guess, is Fed minutes tomorrow.
Yeah, we're all going to be watching that. Unfortunately, a little bit of the surprise is gone. But when you look at the calendar ahead, it's heavily weighted toward the end of the week, starting tomorrow with the Fed minutes. We also get existing home sales today. We'll see what the housing industry is doing. But we get jobless claims on Thursday. That's always been a surprise. And then Friday, as I mentioned, income spending and PCE inflation, along with a lot of Fed speak this week. We'll see what people are thinking about going into March. March really starts off Friday with the PCE numbers on inflation, particularly for core services. The minutes, though, the surprise is gone. Loretta Mester already revealed that she wanted to go 50 or thought there was a case for 50. Jim Bullard did too. Who else, though? We'll be looking to see if there is a larger group that thinks they need to go 50 basis points. We'll see what they say about the terminal rate, whether that's raised from 5.25% to 5.5% or so. And then rates and the recession outlook. They want to keep rates higher for longer, but do they think a recession is getting closer or farther away? And then, of course, as I mentioned, the inflation outlook, services ex housing. Bring up that chart. This is the new favorite one for Jay Powell and the Fed. They think that that blue line has to come down. That's services. Take out housing services because we know the housing numbers distort the overall inflation picture because they're delayed, and you have an idea of what the Fed thinks the inflation outlook is. So a lot to look forward to as we get towards the end of the week, and then we start to roll over into March and the jobs report, the CPI report, and all the things that will help the Fed make their final decision.
Mike, let's go back to the start of February if we can. You were in the room with Chairman Powell. He was asked about whether they had discussed a pause at that Fed meeting, and he said, look to the minutes. I'm trying to work out, Mike, whether this is to stage a platform for the Hawks or the Doves in the minutes to come tomorrow.
Well, that's an interesting question, and we will find out about pause. But the problem here is that the data since Jay Powell spoke have kind of made that no longer an operative view, because if we see this kind of strength going forward, there won't be a pause. And if we see real weakness, then the pause comes back into effect. So 3-week-old minutes, unfortunately, don't give us necessarily a good view into what's happening down the road.
Mike McKee, thank you. A lot of people have changed their call recently. Goldman's Jan Hatzius said just last week, in light of the stronger growth and firmer inflation news, we're adding a 25 basis point rate hike in June to our forecast. They now have a peak of 525 to 550. We caught up with them recently. Take a listen.
We've seen some higher inflation numbers for January. I don't necessarily think that breaks the trend towards disinflation, but I think it reinforces the idea that the Fed still has work to do. And so we think another 75 basis points from here with no cuts until 2024 seemed like a more likely outcome.
Stephanie Roth, to come to you on some of that, a lot of people have changed their projection for the so-called terminal rate, the peak rate in this hiking cycle from the Federal Reserve. I've got a 2-year at 470 again. Is there much upside risk there around that story at the front end of the curve, given what's already priced?
I think there's a little bit of risk, but right now the market seems to have adjusted to the data that have come out. And given that our view is that the February data should show a bit of a reversal to some extent, I think what's in the price makes sense. I think the March payrolls are going to be one of the most important things, and it's unfortunate that it comes in a week later than normally would be the case. So March 10th is going to be a long ways away. But I do think what's in the price makes sense for what the Fed will do, given what's played out over the data over the past couple of weeks.
Tony, are Treasuries a buy here?
You know, Jonathan, I think that they are certainly at worst case neutral, or possibly a buy, though. In the long end, they're much closer to buy than the front end. That question mark about, say, whether there's going to be another 25 basis points at the June meeting, that is really going to drive the 2-year. We could see the 2-year hitting 5%, so that 2s, 10s inversion. Whereas as we came into the year, we thought it would be in a 50 to 75 basis point range. Now you're looking at maybe 75 to as much as 100 basis points. But when we look at the longer end of the curve, there I think we are pricing in both the Fed movement and the implications of that for the economy. So as we expect to see that slowdown in the second half of the year, we think that you'll see the 10-year rate dropping more into the 3 to 3.5 zone rather than the 3.5 to 4% that we've been living in so far this year.
2-year, 10-year spread right now close to negative 80. Stephanie, you'll also recall that we came into this year and people were looking for a break in the correlation between risks, say equities, and what happens in bonds. At the moment, though, it's stocks down, bonds down, yields up. Where's that break coming?
Yeah, it feels a little bit like early 2022 yet again. We don't think that will take that much longer for the benefit between the stock-bond correlation to come into play. I would think around the February data, once we see that economic growth is actually weakening, I think we should see a negative correlation return in stocks and bonds again.
Tony, do you agree?
We do. We think that you will see a negative correlation return. It might take a little bit here through the next couple of months of data just to confirm that the January strength is not going to continue here, and we in fact get the economy taking off. But we do think you'll see that, and then you'll see that correlation return to the pre-pandemic levels.
Tony, out of interest, what would change your mind? If it wasn't the January data, what would?
It would be a confirmation of that January data. So when you look at the jobs data, you'd have to see continued, 300,000 plus type of monthly numbers with the unemployment rate continue to go down. That is going to create a very hawkish Fed. So in our minds, really, the strength in the data would merely just delay the hard landing that would happen because the Fed would have to take the funds rate to a much higher level than what we're currently expecting. But we do think you'll see moderation both in the labor market and what you see from the consumer in terms of services spending, goods spending, et cetera. data is what would change our mind.
It's some scenario analysis, Stephanie, that maybe we can throw at you as well. If the February data did confirm January, how would it change your view?
Yeah, I think that would mean a bigger recession later. So this concept of no landing, I don't think makes sense. I think really what it means is a harder landing, but later. So that would be more like a 2024 recession as opposed to the 2023 recession that we're expecting.
Stephanie, if we defined what a no landing is yet, it feels so loosely defined still.
It sure does. I don't exactly know what that means. I really think it means a harder landing, but later. And that would be a 2024 recession. It means the Fed would have to go more than what's in the price and cause a bigger recession at the end of the day. Again, not our view. We think that there's enough in the price to cause a material slowdown later this year, but that's the risk.
Tony, final word on that.
The final word, Jonathan, is probably that no landing is really just French for delayed hard landing. So our expectations, you will see softening in the economic picture as we move through the rest of the year.
You're on the same page. Stephanie Roth, Tony Rodriguez, sticking with us. Coming up, President Biden rallying Eastern Europe.
1 year later, Kyiv stands, and Ukraine stands. Democracy stands. The Americans stands with you, and the world stands with you.
The president in Poland today tackling tensions with Russia and China. We're live next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
That dark night, 1 year ago, the world was literally at the time bracing for the fall of Kyiv. 1 year later, Kyiv stands, and Ukraine stands. Democracy stands. The Americans stands with you, and the world stands with you.
President Biden visiting Poland after a surprise trip to Kyiv, meeting with Eastern European leaders and hoping to rally support for Ukraine. This as Russian President Vladimir Putin holds the country's nuclear pact with the US and vows to press on, saying in an address to Parliament, quote, "We will fulfill the task set, step by step, carefully and consistently." Our team coverage begins right now with Bloomberg's Maria Tadeo in Brussels and AMH over in Warsaw. Anne-Marie, first to you, what you've heard from the President in the last 24 hours, what you expect to hear in the next couple of hours.
Well, Jonathan, fresh off that trip to Kiev, this one that was shrouded in secrecy, the president finally made that scheduled trip to Warsaw. He had the bilateral meeting. He's in that extended bilateral Now, we got some comments at the top with his Polish counterpart, President Duda, and one comment that really stood out was the fact when the president said the United States needs Poland and NATO just as much as NATO needs the United States. And he's talking about how this is paramount, this security alliance when it comes to NATO. He says it's the most consequential security alliance in history. And that's going to be a tagline that carries throughout the day and through tomorrow. Tonight he'll be giving really from what we saw from Moscow, about 800 miles away, where right now from President Putin. President Biden is going to make sure that this support, this war fatigue potentially that's starting to creep up around the world as they mark 1 year on, remains the fact that the allies, he wants to make sure they remain committed to supporting and funding Ukraine.
Maria, great to have you with us as well. Maria, can you compare and contrast what we heard from the President of the United States and what we heard from Russia's leader?
Look, I think from Vladimir Putin today, it was a repetition of this very Russian line that he is fighting for the soul of Russia, that he is fighting for the historical lands, the historical truth of Russia, and the operation, as you alluded to, will continue. When you look at that speech, in some ways he repeated what has been the standard line from the Kremlin. The operation may not look like it's moving fast, but the reality is Russia is not just fighting Ukraine, it is fighting the West and NATO, and this is why things are not going quickly. And the Russian president obviously knows, and his people know, that this is an operation and a war that's been going on for a year. This is not the fast and easy job that they expected would happen. The Russian people are very aware. They may not protest in numbers, but they are very aware the Russian men are dying in the front, and they are dying in Ukraine. The justification for it is that Russia is being attacked by bigger powers in Ukraine. This is a pawn in a much bigger global war. That's essentially what Russia would say. Now, we also had some comments on the nuclear disarmament treaty. Remember, the president suggested, the Russian president, that Russia will suspend its participation, not pull out entirely, but suspend it for the time being. And to me, it's also interesting, the conversations that he will be having with the top Chinese diplomat this week. Remember, the Chinese have said they have a peace formula for Ukraine. I can tell you, Jonathan, I spoke to a top European official who told me he is, quote, curious, but also very concerned about this peace plan from the Chinese. He wondered, they've done nothing for a year. What do they want to mediate now? And then two, they cannot pass off a land grab as a just peace for Ukraine. That is something the West could not and must not allow.
Maria, just briefly, the situation last year, we had this big economic threat hanging over the global economy, particularly in Europe as well. And Maria, that was able, the leaders of Europe were able to use that to leverage and get support for Ukraine and the war effort. Maria, looking at the data this morning, the data looks so much better. How are they going to keep on doing that?
Yes, and also, by the way, just this time a year ago, remember Russia's spokesman for Vladimir Putin, Mr. Peskov, has told the world that Russia had no plans, by the way, to invade Ukraine. We know that was a very different situation, and they did invade. It is now a full-scale war going into a year. Now, to answer your question, I think for a lot of European leaders, there is relief that their plan to pull away from Russian oil, gas, has worked to some extent. It has come at a price, but we see gas prices also coming down. And then, two, that their interventions in the fiscal support has worked. I think the bigger question is not the next few to 3 months. It will be, what do we do in the next winter? But overall, yes, there is relief in Europe that the worst case scenario did not manifest. And I have spoken to many officials who told me Vladimir Putin made a bet that Europe would freeze and that the economy would crumble. That did not happen. A lot of it because the weather was also mild. That is a luck component to this.
True. It just did not materialize for many reasons. AMH, Maria, to the two of you, fantastic as always. Back with us for a final word. Stephanie Roth, Tony Rodriguez. Stephanie, the data out of Europe, better. Germany, better. The UK, better. The services PMI picking up and yields are pushing higher too. When you think about treasuries and what the Fed might do, how important is the global backdrop to all of this as well?
The global backdrop is certainly important, but I would say the domestic factors are going to be the primary driver here. So certainly the Europe backdrop looks better. That's one reason why we're recommending European equities here over U.S., at least for the incremental dollar. But when it comes to the Fed, they really have to get a handle on domestic inflation, and that's not really driven by the global backdrop at this point. It's really driven by the tight labor market. So wages are the most important thing for the Fed.
Tony, a U.S. story or a global one?
Well, I agree that the U.S. wage data is going to be the most important, but we think it is a global story. It's really that resilience that we're seeing in Europe. Obviously, warm weather. They did a nice job about finding other supplies for gas. They cut down on usage. all of that supports their economy, and obviously the China reopening is pretty significant from that perspective. So that overall growth story is very, I think, supportive of the U.S. growth story, decelerating at a slower pace, and therefore, again, avoiding any kind of hard landing, that it also supports higher yields across the globe. So that's why we think we're going to be in this range-bound area when you look at the long end of the curve, and we won't see a decline until much later this year.
Stephanie, just when it comes to the European equity call, we've heard a lot of that. Where in the European equity story do you want to be? Are you capturing the China reopening, luxury, the miners? Where do you want to be?
A lot of it's the luxury. That's a tremendous benefit given China's going to be reopening certainly earlier than anyone expected. So that's our favorite area to play it.
You're not alone. Luxury, the airlines, even the banks have rallied so hard off the lows of last year. Stephanie Roth, thanks for coming in. We appreciate it. Tony Rodriguez, thank you to you as well, sir. On this bond market, the global economy and these central banks, yields are up this morning, 390 on a 10-year. Yields up by 8 or 9 basis points on that maturity. On a 2-year, up by 7 to just close to 470, 469. Coming up in the morning calls and later, Keith Lerner of Truist, expecting the Fed to put a cap on equity valuations. That conversation just around the corner. Equity futures on the S&P about 7 minutes away from the opening bout, down about 0.9% as we kick off a brand new trading week.
Did art conservation help you in any way to be a better investor? And should a lot of good investors who learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Remember they told us at the start of the year we'd get that break in that correlation between stocks and bonds. We don't have that break, not yet anyway. Equity futures down by about 1%. We're down by 1.3% on the NASDAQ. And guess what treasuries are doing? They're lower too. Yields are higher. We're playing that game again. 2s, 10s and 30s look like this. Close to 470 on a 2-year, up 7 or 8 basis points to 469 on a 10-year. We're back through 390, up 9 basis points on the day. That's the price action. Let's get you some morning calls. First up, JP Morgan downgrading AutoNation to underweight. 130 price target, seeing a less attractive risk reward with shares hovering at record highs. That stock is negative by 2.26% in the pre-market. Truist downgrading Generac to hold. 145 price target, expecting higher rates and product prices to weigh on upcoming results. That stock is negative about 2.9%. And your final call from HSBC, down upgrading Mosaic to reduce, pointing to weakening demand and growing risk to consensus estimates. That stock also down by about 2.8% to 48.45. Coming up, futures pointing to more declines after 2 weeks of losses. Truist co-CIO Keith Lerner says it's time to get more defensive as the Fed puts a lid on the rally. Your opening bell next.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Seconds away from the opening bound this morning. Good morning. Tuesday morning, back stateside after a long weekend with equity futures negative 1% on the S&P and the Nasdaq down by about 1.3%, coming off the back of a two-day losing streak on the S&P and the first two-week loss of 2023. From New York, there's your opening bow. Switch at the board and get to the bond market. Yields up, data better, services PMIs improve. We're higher by 9 basis points on a 10-year. Your 10-year right now, 390.58. A touch of dollar strength out there. Euro dollar negative 0.2%, 106.62. And crude just about holding on, 0.7%, $76 and about 80 cents. About 15 seconds into this one, we're lower by 0.9% on the S&P. On the Nasdaq, down by 1.26%. One stock to watch at the open, Walmart, the world's largest retailer, issuing a disappointing outlook, signaling another rocky year ahead. The CFO said this: there's a great deal of uncertainty looking out to the balance of the year. There's still pressure on the consumer. Our guidance reflects a cautious outlook on the macroeconomic environment. Abby has more. Hey, Abby.
Hey, John. Well, it's such an interesting divergence given the fact that we've had some of the luxury items and travel and leisure outperforming. But here we have staples, these big box retailers having a tough time. Walmart, in fact, right now having its worst day of the year, stumbling the most, down the most since November of last year. And it does have to do with that outlook for profits. The big deal here is last year it was also a drop for profits, this first time in 6 years. So now we're looking at 2 annual slides in profits potentially in a row. Investors really not liking that. It seems that some of the issue, it continues to be the fact that inventories last year, we had that inventory build, that they haven't had a quick rebound out of it. They also misjudged the product mix amid soaring inflation. They had apparel and other items, too much of those items, but it was staples and really the staples that really did much better, including food, groceries. We also had health and wellness. Food and groceries up high to mid-teens. Overall, just a mid-single-digit comp. So a similar story for Home Depot. Their do-it-your-home projects are slowing, apparently. They have also forecasted a drop in profits. Part of that is a $1 billion investment to gain and retain quality hourly workers to create the shopper experience that they want for their consumers, their clients. However, considering that drop, that they have a drop in demand, some analysts are saying this is really a risky bet. John, this is incredible. They are looking at a 0.3 drop in same-store sales. Compare that to 31% higher just in 2021. It's really been a stark turnaround to the downside for Home Depot.
Home Depot down 3.7% in early trading. Abby, thanks for that. The outlook for earnings not tremendous. The outlook for labor costs not encouraging. We'll pick up on that story in just a moment. We'll do that as well a little bit later with the Walmart CFO, Kelly and Guy, catching up with John David Rainey a little bit later this morning, 10:30 Eastern Time. Look out for that. Look out for this too. Another stock to watch, Manchester United, the bidding war heating up with Britain's richest man, Jim Ratcliffe, and Elliot's Paul Singer all getting involved. The deal could represent the biggest takeover of a professional sports club on record. That stock coming in about 3%. Guy Johnson in London on this story. Guy, the bidding, does it continue?
It looks like it does, though I have to say the Glazer family look like they're getting quite ticked off as well about some of the comments that are being made about the club. Talk of returning Manchester United to the glory years, maybe a reference to the way that maybe the Glazers have managed the business and maybe the lack of silverware that has been generated during that period. So it's not inconceivable that this sale doesn't go ahead, John. The Glazers actually hang on to the family, hang on to this as a family business. We'll see what happens. Jim Ratcliffe, as you can see on the left-hand side of your screen, Britain's richest man, a Manchester United fan. He wants to take the club over. He basically wants to buy out the Glazers, i.e. the shares that they own, but that would involve debt. You've got Sheikh Jassim as well, out of Qatar. He is talking about a debt-free offer for Manchester United, which would mean maybe more investment into the club going forward. But then there's the issue as well of the fact that the Qataris also own PSG in Paris Saint-Germain, and maybe that would be an issue when it comes to European football.
A guy just on Elliot, Paul Singer, what's the latest with that? Is that a minority stake he's offering?
No, he's not offering he's offering financing, John. He's not offering to buy a stake in the business. So Elliot's basically talking about providing financing. It is not talking about taking a direct stake in the football club. So it is a more of an arm's length element to the story that is coming through. But the US banks is fascinating. There's a great story on the terminal today talking about the fact the US banks have really woken up to what is happening with football, with soccer, and are now playing a major part in terms of the financing packages that are being offered. But that's the Elliott role in this story.
Fascinating. I just wonder, Guy, if that might be the reason why the stock's pulling back today.
Maybe. There's certainly the possibility that it doesn't go ahead. It's interesting, Liverpool Football Club, which has been talked about as well as being potentially on the block, that is now no longer going forward. So there are some issues here, and I think the Glazers are a little annoyed about the fact that like Sir Jim Ratcliffe's talking about returning the club to the glory years. I think that probably is annoying a few people within the Glazer families. Maybe they're going to say, you know what, we're going to stick with it. Manchester United are on a great run now. People are talking about winning silverware this year, so maybe that would be the moment that they would want to exit.
Rashford getting it done. I could continue this for a long time, Guy. This was fun. Thank you. Let's do this again. Guy Johnson, any excuse to talk about football around the opening bout in New York. Manchester United down about 3.7%. US-listed China stocks getting hammered. The nation's biggest internet companies ramping up their spending as Beijing eases its crackdown, fueling fresh margin concerns. Kelly Lyons joins us now with more. Hi, Kaylee.
Hey, John. Yeah, this is the idea that the shackles are coming off after so many of these companies have been really trying to play it low key for so long. Now that Beijing is easing up on that crackdown, they're starting to try to compete more heavily. So you are seeing some moves in the market related to this. The most prominent example today, JD.com, those ADRs down about 8.4% right now. The latest news there reportedly is that JD is getting ready to roll out a $1.5 billion subsidy program next month in order to fend off competition from other players like PDD Holdings. That apparently those subsidies will be for both JD self-operated storefronts as well as third parties. And there's other examples of this too, like Meituan expanding in Hong Kong, getting ready to hire 10,000 new workers in mainland China as they embark on a campaign to fend off heightened competition in the food space from players like ByteDance. Then there's also the news we got a few weeks ago of Baidu getting ready to launch its own AI chatbot, trying to steal more ad revenue from the likes of Alibaba and Tencent. So these companies are trying to snatch more market share. You aren't seeing, though, a great positive performance for many of these stocks, at least those listed in the U.S. When you look at the ADRs of some of those large cap tech companies as measured by the Golden Dragon China Index, we're now off 11.7% from the recent high at the end of January. So adding to those losses this morning, you have JD, as I said, down about 8%, Alibaba down about 3%, and Baidu down about 2% in the first few minutes of trading as well, John.
Kelly Lyons, welcome back. It's good to have you back down in Washington, D.C., covering some of these regulatory stories for us. Your equity market pulling back a little bit, 7 minutes in, down 0.9%. Keith Linner at Truist seeing a lose-lose situation for markets. He wrote the following: we see a reverse taper trade underway. If the economy stays stronger, central banks will maintain a tight monetary policy, putting a cap on equity valuations, or if the economy starts to weaken, this will likely translate into lower corporate profits and challenge asset prices. Keith joins us right now. Keith, for those who don't remember, and thanks for being with us, can you remind us of what the taper trade was?
Sure, Jonathan, and great to be with you. Yeah, in 2010, coming out of the financial crisis, the market has started to move up, and there was a lot of angst for the market. And David Tepper came out very succinctly, said we have basically a win-win situation. Either the economy is going to get better, and that's going to help corporate profits and help the stock market, or instead, the Fed will step in, which will also help the economy. So our point of view, Jonathan, is today is somewhat of the reverse of that, in that either the economy is going to get stronger and the Fed's going to stay tighter, as you just alluded to, or as we saw with Walmart today, that the economy will start to weaken, and that will hurt corporate profits as well. So the bottom line is that we think the upside is somewhat capped. And then in the first week of February, we actually took down equities and raised some cash in light of that.
So, Keith, a lot of people at the start of the year said the same thing. And now the Nasdaq's up 13%, pulled back from those levels this morning, of course, but up double figures. What happened, Keith?
Well, I think perspective is helpful, Jonathan. So the market's had a nice move, as we change the calendar. But look at the S&P. The S&P in mid-December was around 4,100. We're below that today. So what happened, Jonathan, is that we had a sell-off in mid-December, about 5 or 6%. You had tax loss selling. As that subsided, the market has come back. But again, if you remove the calendar, we're basically just where we were back in September. And then going to the technology, what we saw, we did an interesting study in January, Jonathan. The bottom 50 stocks in the S&P, which were down over 50% last year, in January alone were up 40%. Every single one of those bottom 50 stocks were up. So what does that tell you? That's not fundamental. That was a mean reversion trade. And part of the reason why we raised cash earlier in February was thinking that was just, an overdone reversion, not the start of a new bull market, which I guess, is the open question out there. But we're on the side that it's not the start of something new.
I think that is the open question. So let's go there. It's whether October was the low of this bear market, and Keith, whether what we've seen year to date is the beginning of something new. And Keith, I'm more interested in how you work out that answer than the answer itself. What's the process you go through to try and consider whether October was the low?
Yeah, well, I think the important thing, Jonathan, is we have to keep an open mind to different outcomes, especially in this post-pandemic world. So I'll give you the bullish outcome, and this is more strictly from more of a technical standpoint. You made a low in October. That was the same day as a generational high in inflation, right? So you bottomed on bad news. Over the last several months, you've had very negative sentiment, and despite that, or maybe because of that, you started to move up slowly and surely. You've seen breadth participate or broaden out quite a bit. You're broken above some technical levels as well. But what holds us back from endorsing that view, and we look at the weight of the evidence, and we look at the macro conditions. This morning, Walmart talked about how uncertain things are in the second half. And we look at the fundamental perspective. Recently you were trading well above an 18 forward multiple. And to put that in perspective is, over the last 30 years, you're only able to sustain a level above that twice: the technology bubble or the pandemic overshoot. So the question we have to ask ourselves, is that premium valuation warranted given the macro risk? Our view is no. The other thing that you would be banking on, Jonathan, is that earnings are going to be much stronger than the street forecast. Well, what are we seeing today? We're seeing the forward earning estimates for the S&P make a 52-week low, while valuations are at a premium. That's not a combination for a large upside move in our view.
Walmart recovering just a little bit. We've mentioned that stock a few times this morning. It's now down just 0.8%. Keith, the other aspect of all of this is just history. Mislav Matejka at JP Morgan kicked off the week with this line: we've never seen a low before the Fed has stopped hiking. How important is that line, Keith?
Well, it's important. We've actually used, we've done similar analysis. To be fair, Jonathan, we've also had a 25% peak to trough correction, which is abnormal before a recession even begins, as an example. So I think, the forward guidance that the Fed has, that's changed things because things filter into the market so much quicker. So I do think about that aspect, but overall, I do agree that History does show that it would be unusual for the market to have the low end based on that. But even if let's forget about that for a second. Let's forget about hard landing or soft landing. The market at this point, in our view, is baking in a very good scenario with little margin for error. And even if you say, yes, we're in the soft landing camp, well, the market, in our view, is already pricing that in, both on the equity side, and then you look at credit spreads, which are extremely tight, also not baking in much recession risk either. So we just think the downside risk is higher than the upside risk, and that's why, again, we're more defensive in our overall posture today.
The so-called reverse Tepper trade. Keith, this was great. Don't be a stranger. It's always great to catch up. Keith Lerner there of Truist. Thank you, sir. About 12 or 13 minutes into this session, equities pulling back. We're off the lows, though. We're down 0.8% on the S&P and the Nasdaq. We're down about 0.9%. Coming up, Credit Suisse, the chairman, speaking to Bloomberg back in December.
The outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
Those comments said to be leading to some regulatory scrutiny. We'll have that conversation next.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Outflows basically have stopped. What we saw is 2-3 weeks in October, boom. And since then, flattening out, they have stopped. It's gradually coming back, in particular in Switzerland.
That was the Credit Suisse chairman, Axel Lehmann, speaking to Bloomberg, and Francine Lacroix back in December. Shares this morning hitting a fresh record low after Reuters reports that the regulator in Switzerland is investigating whether those remarks misled investors. Credit Suisse declined to comment on the report. Joining us now is Bloomberg's Jan-Patrick Barnett in Frankfurt. Jan-Patrick, always fantastic to get your perspective. What's happening here?
Well, it's horrible to watch Credit Suisse unable to get anything right. And now with the last thing that they want right now is regulatory scrutiny. And especially this incident probably has no good outcome for Credit Suisse, because either the management has been untruthful about what outflows are actually looking. So that's an obvious red flag. Or if they have been right and just unlucky with the timing of the comments and then outflows resumed shortly after, it shows you that the management is unable to do anything to stop that bleeding for the bank. So whatever it is, it's probably not good for the bank. If you look at the share price, it's down tremendously, and that in a time when all other banks are rallying based on the higher yields. So Credit Suisse really has an issue here to renew trust from investors and from the clients. And if I have to make a prediction, I would say that this probably is going on for a little bit longer, because right now, as I said, the bank is just unable to get anything right here.
260 on the stock does not look good. We're down another 4%. Jan-Patrick, thank you. Joining us now to discuss is Filippo Anuati, the head of financials at Federated Hermes. Filippo, fantastic to speak to you, sir, as always. There's one question I had, Filippo, just reading this story. Those remarks were made right before the close of a $4 billion capital raise. And I wonder, Filippo, whether he was communicating the same thing, whether the company was communicating the same thing to the people who bought into that capital raise.
Yeah, I think it's a bit complicated. So I think I saw the chair, and we just heard again what he said. He was on purpose a little bit vague. And I mean, so you can argue that in some part of the Credit Suisse group, like for example in Switzerland, as he mentioned, they were already, the deposit actually were reverting. And also he's mentioned flattening out. So these are mathematical terms, a second derivative. So you can say that on purpose, or he's been a little bit vague. And of course, I mean, we know that was the rights they were pricing, because I think they only settled on the 10th of December, so before the interview with Francine. So it was a bit, should I say, I think it's one of half glass, half full, half empty type of the situation. And I think one of the duty of the chair is also to instill confidence in the group. And I think he was playing this part of instilling confidence in the group.
It's also taken our attention back to a difficult time for the bank and taken our attention away from where the bank is right now. Filippo, I wonder what the inflows-outflows situation looks like currently. What's your read on that?
Yeah, I think it's the situation, and that's based on the Q4 number they disclosed a few weeks back. It has stabilized, but it has stabilized at a cost to the P&L of the group, because so we know there's been some, I would say, punchy marketing campaign both in Switzerland and in Asia Pacific in order to get those deposit back. And I think also in this kind of situation, that's what you want them to do in order to stabilize the, say, the funding profile of the group and have these outflows, so consign these outflows things to the past. And I think also, yeah, it's a difficult job then trying to achieve, and to say that they all get things wrong, I think it's a little bit too simplistic.
Filippo, just a final one from me, if I may. This year is a write-off for the bank. Based on the communication we've had, it looks like 2023 is going to be very difficult to make profit. 2024 seems to be the next landing point. How difficult will it be to turn around the bank, even in the next 12 months?
I think it will be difficult. The execution risk is high, and I think also they've been very upfront, at least in the Q4 call, saying we'll make a huge loss in 2023. It's possible also 24 will be another difficult year, and then also they're only forecasting a relatively pedestrian return on tangible equity by 2025. So it will take some time, and I think also we've been there with previous situations, like for example NatWest, Deutsche Bank, Danske Bank to some extent. So it takes time, it takes patience, and I think the best thing for Credit Suisse is to just stay out of the news for quite some time, but it will be difficult.
They're struggling to do just that. Filippo Anuati of Federated Hermes. Filippo, thank you, sir. Stock's down 4%. Stock's trading at 266. We actually had some decent data out of Europe earlier this morning on the services side. Mike McKee, we're seeing a very, very similar story out of the US this morning.
We are indeed, John. One of your guests at the top of the show was making the case that a recession may be coming because the January data were unusually and maybe strangely strong. This is February data. The S&P Global Manufacturing PMI comes in better than expected, up from last month, 47.8 compared with 46.9. Now, that's not too bad. It is a bit of good news. But you look at what's happened with services and composite PMI, both of them back over 50. The services PMI goes up to 50.5 from 46.8, a significant move. 50.2 for the composite, also from 46.8. So two significant moves in the services and composite that put us back into expansion territory for February. This matches what we've seen going on in Europe. You mentioned that. Almost every country there had the same story as the United States, with France, Germany, the Eurozone, and the UK seeing manufacturing still below 50, although a little bit better, but services in all of those countries higher than 50 now, and the composite in all of those countries higher than 50 now. So it does look like there is more strength in the global economy. And I got to say, it may be showing that Christine Lagarde is not the most powerful woman in the European economy. It may be Mother Nature. What analysts are suggesting, and that may be true in the United States as well, is that the winter has been mild enough that people have had extra money they would have spent on natural gas or other utilities to spend, and they haven't been kept inside by storms. So maybe this year is a Mother Nature year to watch.
At least the first couple of months of the year anyway. Mike, thanks for that. The weather component of the year so far, the data's just been tremendous. I remember at the start of the year, we had sub 50 PMIs on S&P Global, looking at the US, and credit spreads were at 400 basis points on high yield. And I said to Gershon Distenfeld of AB, this does not make sense. And he said to me, one or two things needs to happen. Either spreads are going to gap out wider again, or the PMIs are going to recover. What we're seeing right now is the PMIs starting to recover. Watch this space. Your equity market down another 1%. Up next, your trading diary.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
This is Bloomberg.
The PMIs worldwide looking pretty good relative to expectations and relative to where they have been. Equities off the back of better data lower because yields are higher. We're down 1% on the S&P, on the Nasdaq. We're down a little more than 1 full percentage point as well. That's the price action. Here's your trading diary. Coming up, President Biden set to speak in Poland, 11:30 Eastern time. Fed minutes on Wednesday. Look out for that tomorrow. We'll hear from President Bostic's daily of the Fed speaking on Thursday. Plus we get US GDP, core PCE, another round of jobless claims as well. And finally, new home sales, personal income and spending numbers, and new Mitch sentiment survey. to round out the week. That rounds out the morning for me. Good morning. This was the countdown to the Open. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man named only as Sergei W. stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Venergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not 0, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, It may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your